So, good morning everyone. Am I audible? Can you please respond? So, friends, am I audible? So, I hope both my audio, video, everything is clear. Can you guys please respond? Those who are there in live, if you can respond, it will be good. All good, right? Good morning, Savrav. Good morning, Rock. Hope you are all good. I can see your messages. Yes, keep on texting throughout the session, okay? Yeah, the classes are there in Zoom as well as in YouTube. Okay, you can join any, no problem. We are streaming both via Zoom as well as YouTube. Good morning, Anpa. Good morning. Yes. Okay, friends. So let's not waste time. Let's start our powerhouse revision session 3, that is direct tax paper 3A. Today we are about to revise PGBP, that is profits or gains from business or profession. So as you all know, that is one of the most important chapter in our PGBP. Okay, 1 second. Sir, you're not accepting my request in Zoom meeting. Oh, is that so? Let me check. Zoom meeting. There is no problem for the time being. There is no problem. Yeah, I hope you can hear my voice in live, right? Zoom meeting, I haven't received any request yet from you. Rock, I didn't see your request in Zoom.
Recording stopped.
Yeah, you can attend in YouTube itself. Okay, all right. So we'll start, friends. Let's not waste time. you can chat with me via YouTube itself. Okay, no problem at all. So starting with our revision, that is profits and gains from business or profession. That is one of the most important chapters in our paper 3A, direct tax laws. Now friends, listen, we are about to revise this chapter in an examination perspective. Okay, so whatever important things there in exam we will cover in today's session, and towards the end I'll make you solve a question that is your Jan 2025 past examination question as well. That is towards the end of this particular session. I'll make you solve this particular question. This is a 15-mark question which is tested in your Jan 2025. As you can see it from here, this question, when we solve it, you will get a better understanding of this PGBP, and we will be learning a few things from other heads as well. So when we discuss this question has something from salary, some basics from house property, and something from IFOs is there, some chapter 6A deductions are there. So this is a comprehensive question, and when we solve this question you will get a better idea on how to deal with such questions in your exams. So this is what our plan is. So first of all, let me go through the theoretical aspects of this chapter, that is PGBP. Once we complete the theory, we will get back into the question. I'll make you solve this question and I'll tell you how to present this question in exam. These kinds of questions will be there. That is for sure in your exams. And I'll tell you how to present your answer, because presenting your answer is yet another important thing, because every working note does carries a mark. So it is not like you have written the final answer right, you will not be getting the full marks. The presentation is very much important, and you should write the exam, you should write the working notes and the other things in a proper way. Only then you will be getting full marks for that respective question. It is not like you write the final answer, you will be getting the marks. So you have to be very careful while writing the working notes. So friends, without wasting time, let's get into the revision. So PGBP is the one that we are about to revise. So whenever there is a question from PGBP in examination, they will definitely give what? Net profit as per the P&L account. The one thing that will be there in every question will be net profit as per the P&L account. So friends, listen. So in this question also you can see there is actually a net profit as per P&L account. So every time you start from the net profit as per the P&L account, that is the starting point. Okay, to the net profit, what you should understand is there are certain allowable deductions. Okay, so to the net profit, there are certain allowable deductions. That means deductions that you can claim. And there are certain disallowances. That means deductions that you cannot claim. So first we are about to discuss which all are the allowable deductions. So allowable deductions. So friends, please listen. In examination, if the question says these deductions, that means these deductions under the category allowable deductions, if they are saying it is already debited to the statement of P&L account. Okay, please listen. If in the question, if they are saying these allowable deductions are already debited to the statement of P&L account, then you do nothing to the math, but you should write a working note. Say for example, section 30 is the first one, expenses relating to building. Imagine in the question they are saying this expense have already debited to your statement of P&L account. Then what you need to do? You need to write a note that under section 30, expenditure related to building already debited to the statement of P&L account. It is allowed as a deduction and hence no further adjustment required. Then you write nothing in the numerical part. But you need to write a note, because that note does carries a mark. So it is not like if there is something where you don't need to write anything to the numerical part, but you should write a working note in a specific manner, so that you should communicate that working note to the institute in the proper manner. Okay. So listen, let's start with the allowable deductions. The first one is section 30, that is expenses related to building which is used for your business or profession. Imagine you are running your business in a building. Okay, imagine you are running your business in a building. It can be either owned or it can be on a rental basis. Okay, it can be either owned or it can be a rental basis. So you have hired a particular building and you're running your business in that respective building. Now the point is, these four expenses related to that particular building is allowable as a deduction while computing your profits under PGBP. These 4 expenses you can claim as a deduction while computing your profit from that respective building. Expense number 1, that is rent. Imagine you have taken this building for rent. You have taken this on hire or lease. The rent, lease premium, etc. that you are paying in relation to that respective building is definitely allowed as a deduction under section 30. And imagine if that rent is already debited to the statement of P&L account, then what you need to write? It is already debited to the statement of P&L account, allowable as a deduction under section 30, since it is a rental expenditure related to your building, and hence no final or further adjustment required to the net profit, because they might have already debited this rent to your net profit, and in the question they might have already debited, so you don't need to do anything else. So if these expenses under the category allowable deductions have already debited to the statement of P&L account, you do nothing to the numerical part, only write a working note. That's what I said initially. Now second expenses is current repair. What is current repair? Imagine, say for example, your window have broken. Okay, the building's window have broken and you repaired that particular window. Okay, say it is an AC building or an AC room or an AC office space, and your windows got broken and you have repaired that respective window. That repair cost that you have incurred in relation to that particular building is definitely allowed as a reduction under section 30. So whatever the current repair is allowable as a reduction under section 30. Imagine you have expanded that building. You have expanded that particular building, or you have done some capital additions to that respective building. Those capital additions, expansions, etc. not allowed as a deduction under section 30. All the capital expenditures have to be capitalized along with the actual cost of that respective building, and you can claim depreciation on that capital addition. Got my point or not? So friends, is my pace okay? Can you please respond? Am I audible? You can see whatever I'm writing. Can you please respond in the chat box? Is everything going fine? Please respond. Is everything going fine? Please respond. Okay, Aditya, I have seen your chat. Yeah, all good. How about the others? Please respond. Everything going good, right? Okay, good. All right, fine, friends. So let's continue. So whatever the current repair or the current expenditure that you're incurred or that you're incurring in relation to that respective building, which is used for your business or profession, is definitely allowed as deduction. All the capital expenditures are never allowed as a deduction. So you need to ignore all the capital expenditures that you have incurred in relation to that respective building. So I hope that point is clear for you. Now, moving on to the next one, friends. So next one is rates and taxes. Imagine, say for example, you have a building in a particular local authority and you will be paying municipal taxes. You will be paying municipal taxes in relation to that respective building. Okay, to the corporation, local authority, municipality, panchayat, whatever it is. So you are paying whatever the municipal taxes that you are paying in relation to a building which is used for your business or profession is allowed as a reduction under section 30. So when you hear municipal taxes, you have a tendency to deduct it under house property. No. Wait. If that house property is a rented property, so you have rented that property out to someone. Okay, as an owner, you're getting rental income. Then only that house property will be assessed under the head house property. You got it? Then the rental income will be assessed under the head house property. Then the municipal taxes is allowed as a deduction from the head house property. So here what we are doing is, you are making use of that building to earn business profits. You are using that building for your business activity. Then never dealt it under house property. Then what you need to do is, you need to consider that house property as a part of your business. And whatever the rate of taxes, municipal taxes, etc. that you have paid is allowed as a reduction under section 30. And one more thing, if it is already debited to the statement of P&L account, then you need to write a note. Nothing have to be done to the numerical part of that respective question. I hope you are getting my point. Moving on to the third point, friends, that is insurance premium. What is insurance premium? Imagine you have taken an insurance policy on that respective building. You have taken an insurance policy on that respective building. Whatever the premium that you are paying, premium for that policy that you're paying, say for example, earthquake insurance or any other insurance expenses that you have taken, whatever the premium that you're paying is again allowed as a deduction. You can claim that entire premium cost as a deduction while computing the business profits. So hope you are getting my points. Now friends, moving on. So this is what is related to your building. All these four expenses related to your building which is used for your business is allowed as a deduction under section 30, and if it is already debited to statement of P&L account, you don't need to do anything. That's what I've written here. If already debited to the P&L account, write a note, don't adjust, but you need to write a note because that note does carries mark. So that is the first section, section 30. I hope it is clear. So with the net profit given in the question, if these expenses are already debited, then do nothing, just write a note. If it is not debited to the P&L account, if it is given as an additional adjustment in the question. So in the question, this is the framework. There can be additional adjustments in the question. Okay, they might say the followings are not adjusted to your P&L account. There can be additional adjustments. If it is an additional adjustment, that simply means it is not debited or credited to the statement of P&L account. In such case, what you need to do, you need to deduct these expenses from the net profit to arrive at the final PGBP, that is profits or gains from business or profession. So let's move on to the next expense, friends. Expense number 2, that is under section 31. What is that? Imagine you are using a plant or a machinery or a furniture for your business or profession. Okay, imagine you are using a plant and machinery or a furniture for your business or profession. These two expenses related to that plant and machinery and furniture is definitely allowed as a deduction under section 31. These two expenses which are related to the plant and machinery, furniture, etc. is allowed as a deduction under section 31, and let's start with these two deductions. Starting with the first one, friends, current repair. Imagine you're using a plant and machinery or a furniture for your business or profession. Whatever the current repair expenses you have incurred in relation to this plant and machinery and furniture is allowed as a deduction. Again, imagine, listen, it is only current repairs. What do you mean by current repair? An expenditure that you are incurring to make that particular plant and machinery to use it to your business. Imagine there is some problem, it got damaged. You need to repair it. Okay, then only you can use that particular machinery for your business or profession. So that repair cost is allowed as a deduction. If it is a capital addition, that means an expenditure which increases volume, life, usage, capacity, etc. of an asset, then never claim it as a deduction under 31. You capitalize that cost along with the actual cost of the plant and machinery. Then you charge depreciation which comes under section 32. That is the next section that we are about to discuss. So please listen, pretty simple. If you are using a plant and machinery or a furniture for your business or profession, whatever the current expenses that you are incurred in relation to that plant and machinery and furniture is definitely allowed as a deduction under section 31. I hope that point is also clear. Imagine you have taken a plant and machinery or furniture, you have taken an insurance on the plant and machinery and furniture. Whatever the premium that you are paying in relation to the plant and machinery and furniture is again allowed as a deduction under section 31. So listen friends, two things, all the current repair and insurance premium. Now friends, listen. So the deductions allowable under PGBP starts from section 30 to 37. These are the allowable deductions. So we are about to discuss all the allowable deductions under PGBP. The list of allowable deductions are from section 30 to 37. But in this list, deductions under section 30 to 36, we call it as specific deductions. What do you mean by specific deductions? Specific deduction simply means those deductions which have been notified clearly as an allowable deduction. That means specific deduction means what exactly is the expenditure, how much you can claim as a deduction, everything have been clearly specified in the act itself. And there is one more deduction that is under section 37, we call it as general deduction. So my question is, imagine I've taken a plant and machinery or a furniture on rent. Can I claim that rent as a deduction under section 31? The answer is no. Why? Section 30 to 36 are called as specific deduction. Whatever allowable as a deduction under the respective section only can be claimed as a deduction. If you are incurring any other expenses or any other cost in relation to plant, machinery, furniture, etc., those other costs are never allowed as a deduction under 30 to 36. Imagine you have taken this plant and machinery, furniture, etc. on rent. Then whatever the rent that you are paying is allowed as a deduction only under section 37 because it is called as a general deduction. I hope you are getting my point. So friends, listen. Section 30 to 37 is collectively called as the allowable deductions. Out of 30 to 37, only from 30 to 36 called as specific deduction. Whatever you can claim as a deduction have been notified under the respective section itself. Whatever the other expenses that you are incurring, which is not covered from 30 to 36, is allowed as a reduction under section 37. This is the tip that you should register in your mind while writing your examination. I hope you are getting a point over this. Moving on. So, the rent that you are paying in relation to the plant and machinery, furniture, etc. is not allowed as a reduction under section 31. But you can claim the same as a deduction under section 37 being general deduction. Hope you are getting my point. So, only current repair and insurance premium that you are paying in relation to plant, then furniture, etc. is allowed as a reduction under section 31. Nothing else is allowed as a reduction under section 31. So, we have covered two sections. Section 30 that is related to your building. Section 31 related to your plant and machinery and furniture. All the three assets have to be used for your business or profession. All the rent, rates and taxes, insurance premium, current repair related to your building is allowed as a reduction under section 30, and all the current repair, insurance premium is allowed as a reduction under section 31 if it is related to your plant and machinery and furniture. Hope you are able to follow whatever I am saying. Moving on to the next one, friends. Moving on to the third deduction, that is section 32, depreciation. This is one of the most important deductions that we are about to discuss in this chapter, called as depreciation. And let's understand what exactly is this concept of depreciation. So listen, if you are buying a capital asset, you need to capitalize the value of the asset and you need to charge a percentage of depreciation as a deduction under section 32. Hope you all know what is depreciation. We are just having a revision over that respective topic. Now, most of the assets in an examination question, you need to apply WDV method. This is the most frequently asked method. Actually, there are two methods, WDV method and SLM method. But in 99.99% cases, the examiner will be testing WDV method, that is the written down value method, and you need to know how to compute depreciation under a WDV method. So let's understand how to create or how to claim depreciation under a WDV method, written down value method. The first thing to do is create a block. Create what? Create a block. What is block? Same category, same rate added together, and you claim depreciation on that respective category as a whole. The concept is called as what? Written down value method under section 32. It is not like your accountancy where you will be claiming depreciation for each and every asset based on the proportionate number of days of use. It is not like that in income tax. In income tax, under WDV method, you claim depreciation on the block of asset rather than the individual value of the asset. Say for example, you have plant and machinery 1, plant and machinery 2. They say there are two plant and machineries, one having a value of 10 lakh, the other one having a value of say 2 lakh. And what you need to do is, you need to charge depreciation on the total. You need to charge what? Depreciation on the total of this particular machinery value. And how much is the total of this machinery value? That will be 12 lakhs. 12 lakhs is the total value of this machinery. Then you need to charge depreciation at 15%, that is 1.80 lakh. This is how you need to charge depreciation in income tax. Rather than claiming depreciation on the value of individual assets, you claim the depreciation on the total value of asset. This concept is normally known as what, friends? Block concept. That means you simply create a block. You add all the assets together. That means same category assets with the same rate. You add it together, then charge depreciation on the total value of the block, then claim that depreciation as a deduction under section 32. This is what you are supposed to do. Then on the entire block value you charge the depreciation. That's what the department says. Now friends, listen, you should know which all are the category of assets in income tax. So we will discuss only the important categories. These are the important categories. Actually, there are 5 important categories and its rates. Okay, important category of assets and its rates. So let's understand which all are the important categories and its rates. So let's understand which all are the important category and rates, friends. Starting with the first one, it is called as building. So whatever the building that you have purchased or constructed and you are making use of that building for your business or profession, the entire cost of building have to be capitalized. Only those current repairs are allowed as a reduction under section 30. Whatever building that you are using for your business or profession have to be capitalized. Then you need to charge depreciation over the cost of the building. And how much is the rate of depreciation? That is 10% is the rate of depreciation. So friends, listen, imagine the building value is 10 lakh. You need to apply rate of depreciation at 10% on the building value. Now, so that is a normal general rate that you should by heart. These rates you should mandatorily by heart. Okay. Now, second category of assets is furniture and fittings. Whatever furniture and fittings that you are using for your business or profession, what is the rate of depreciation? Again, 10% shall be the rate of depreciation. For the building, 10%, furniture and fittings, another 10%. And third one is intangibles. Say for example, know-how, patent, copyright, franchisee fees, etc. Intangible assets. You capitalize and charge depreciation at 25%, but you can never claim depreciation for the value of goodwill. Goodwill is not depreciable. Not depreciable under section 32. You cannot claim depreciation over the value of goodwill. What you can do is you can capitalize all other intangible assets and you can charge depreciation over the value of other intangible asset, never on the value of goodwill. That's what the department says. Then the fourth category is ships. What is the rate of depreciation for ships? 20%. So friends, you need to by heart these rates. These are the most important categories and its rate. So you should by heart these rates, because in exams they might give the value of the asset. You need to apply the applicable rate of depreciation. They will never give the rate of depreciation in examination. So make sure that you have learnt all these rates. Okay. Now ships, 20% is the rate of depreciation. And then the fifth one is plant and machinery. Say under plant and machinery category, there are certain subcategories. If it is a motor vehicle, then depreciation is chargeable at 15%. If it is a computer peripheral, then depreciation is chargeable at 40%. If it is windmill, depreciation is chargeable at again 40%. If it is a pollution control equipment, depreciation is chargeable at again 40%. If those are books which is used for your business or profession, rate of depreciation is at 40%. If it is an EV, that is electric vehicle, just like Tata Nexon EV, something like that, if you are using for your business or profession, then rate of depreciation shall be at 40% again. General rate of depreciation shall be 15%. So depends upon the type of asset that you are using for your business or profession, you apply the rate of depreciation as per this chart. Say for example, you have two cars, car 1 and car 2. You add the value of car 1 and car 2 together and apply 15% depreciation on the total value. This is called as creating a block and charging depreciation over the value of the block. This is what you are supposed to do. Now, moving on to the next concept over here, how to compute depreciation. Let's understand how to compute depreciation as per the block concept. Okay, then, listen. So computation of depreciation, let's understand friends. Starting with the first one, you take the opening WDV of the block. You need to take the opening WDV of the block. What is opening WDV of the block? Last year's closing WDV. Closing WDV of last year will be the opening WDV of this year. Okay, so first you need to take the opening WDV of the block. Then additions or purchases during the year. You need to add all the additions and purchases during the year. Irrespective of the date of addition, this is a statutory format. This is a statutory format irrespective of the date order. First, you need to add additions, purchases along with the actual cost of the asset. So, add all the purchases current year. Then, you need to compute opening plus addition. Then you deduct all the sales value from that particular thing. If there is any sale from a respective block, you need to deduct the sale value from that respective block. Then you will be getting what? WDV before depreciation. Then charge depreciation at what? Full rate items that are purchased during the year. If put to use for less than 180 days, then charge 50% of the normal rate. This is an important point. Imagine in the block of asset, there are certain assets which you have purchased and put to use for less than 180 days. Imagine you have purchased an asset and it has been put to use for less than 180 days. What is put to use? That means from the date of installation, the actual date, that means the date that you have actually started using that respective asset for your business is said to be what, friends? Put to use. Imagine I purchased the generator and I've installed it after 1 week. So the put to use is actually starting from that 1 week. Okay, imagine I've purchased the generator on 1st of January and I've started or installed that generator in my premises on 20th of January. So put to use is on 20th of January. It's not on the purchase date. It is all about the put to use date. That's what is relevant while computing depreciation under section 32. So listen friends, if an asset have been purchased in the year of purchase, if it is put to use for less than 180 days, then you can charge only 50% rate of the normal rate. Imagine the normal rate is 15%, then only 50% of 15%, effectively you can charge only 7.5% as the depreciation. This is how you need to compute the depreciation. If an asset is put to use in the year of purchase, if an asset is put to use for less than 180 days, then you can charge only 50% of the normal rate as the depreciation. This is what the department says. I hope you are getting my point. So listen. So you need to compute depreciation like this. Then you need to compute the closing WDV. This is how you have to compute the depreciation. So imagine friends, I'll make use of an example to make you understand the concept of depreciation in a detailed manner. So imagine, say we will create an example over here for a better understanding, because this is very important. Imagine, say on 1st January, or say my opening WDV of an asset of a block is 10 lakh. It contains generator. It's a block of generators. Okay. It is plant and machinery 1 and plant and machinery 2. The opening WDV is 10 lakh. And say on 5th of January 2025, I have a purchase of 2 lakh. Purchase of plant and machinery is how much, friends? 2 lakh. Then say on 10th July 2024, I had another purchase, plant and machinery 3 and plant and machinery 4. Or rather, I will say plant and machinery 3 and plant and machinery 4. This is 5 lakh rupees. Say this is my entire thing. So this is what has happened. So what you need to do is, as per the format, how do you claim depreciation over the value of these assets? Very simple. While claiming depreciation, you simply take the opening WDV. Opening WDV will be 10 lakh. You always add additions. How much is the addition? 2 plus 5, that is 7 lakh. Or rather, I will say additions will write date wise. On 10th July, 2024, I have an addition of rupees 5 lakh. Then on 5th January 2025, I have an addition of say rupees 2 lakh. So 5 plus 2, it will be 7 lakh plus 10, 17 lakh is the total value of asset. Now, how do I claim depreciation? To claim depreciation, I need to categorize this into two, normal rate and half the rate. Okay, which all are the items where I will be getting depreciation at full rate? Imagine this is a plant and machinery 1 and 2 and the general rate is 15%. Okay, imagine the general rate applies over this block and it is 15%. Which all are the asset where I will be getting the full rate of depreciation? Very simple. The opening WDV I will be getting the full rate, and on the addition also I will be getting the full rate, right? So that 10 plus 5, 15 lakh, I will be getting 15% as the depreciation, and on this 2 lakh, that is on 5th January 2025, on that 2 lakh I will be getting only 7.5% as depreciation. So 15 lakh into 15% is how much, friends? So we'll write 15 lakh into 15 percentage, that will be 2,25,000. And on the 2 lakh, that is the second addition, I'll only be getting 7.5 percentage as the depreciation. So on the 2 lakh, 7.5 percentage as the depreciation, that is 15,000. So if I deduct these two, that means from 17 lakh is the total block of my asset minus 2,25,000 minus 15,000. Then my value will be 14,60,000. Will be my closing WDV, and this will be my opening WDV for the next year. So this is how you need to claim the depreciation based on the block concept. Are you able to follow whatever I've said? Please respond, friends. Is that clear? Is it clear, friends? Please respond. All good, all good. So this is how you need to compute the depreciation under WDV method. You need to add all the assets in the same category, same rate, same category. How many categories are there? 5 categories are there. Whatever the assets that you have under a same category, same rate, you add together, then you apply the depreciation on that total figure. This is what is required under section 32. Now, listen. Moving on to the next concept, friends, there is another thing called as additional depreciation, and let's understand what is the concept of additional depreciation right now. So, if you are a manufacturer, and you have purchased eligible plant and machinery, then you are eligible for additional depreciation in the first year of purchase. So, if you are a manufacturer and you have purchased eligible plant and machinery, then you can claim additional depreciation on the first year of purchase. So my question is, can all the assessees claim additional depreciation? The answer is no. Only manufacturers can claim additional depreciation. Can you claim additional depreciation on the value of all the assets? Again, the answer is no. You can claim additional depreciation only on the value of eligible plant and machinery. So you need to be a manufacturer and you need to purchase eligible plant and machinery. If both are there, you can charge what? Additional depreciation, but only in the first year of purchase. So the third question is very much relevant. Can you claim additional depreciation throughout the life of an asset? Again, the answer is no. You can only claim additional depreciation in the first year of purchase. Now, apart from the normal depreciation, how much you can claim as additional depreciation? Assessee can claim additional depreciation at 20%. So, for example, in the first year of purchase, if you are a manufacturer purchasing eligible plant and machinery, you will be getting normal depreciation as normal rate. Apart from that, you will be getting an additional depreciation of 20% on the first year of purchase. This is what the department says under section 32. Now, eligible plant and machinery. Let's understand what is this eligible plant and machinery. What exactly are the eligible plant and machinery? Before that, there is one more note. What is that? Items that are purchased during the year, if put to use for less than 180 days. Imagine you are purchasing an asset and you are using that respective asset for less than 180 days. You are purchasing an asset and you are using that respective asset for less than 180 days. Then additional depreciation is only at 10%. Just like the 50% of normal depreciation, you will be getting only 50% of the additional depreciation. Normal rate is 20, 50% of 20 is 10. So this is what the department say, 50% of 20 in the year of purchase. But there is a problem, friends. You can claim normal depreciation throughout the life of an asset, but you can claim additional depreciation only in the first year of purchase. So what you need to do is, if you are purchasing an asset and put to use that particular asset for less than 180 days, then in the year of purchase you can claim only 10% as additional depreciation. The remaining 10 you can claim in the subsequent year, because what the department say, if you are purchasing an asset and using it for less than 180 days, just like the normal depreciation, you only will be getting 50% as the additional depreciation as well. So that 50% you can claim in year 1 and the balance 50 you can claim in year 2, because additional depreciation can be claimed only once, that is only in the first year. You are using an asset for less than 180 days is not a violation or not illegal or not a crime. No problem, don't worry. You claim full additional depreciation 20% but only in 2 years. This is what is the concept is. You claim 50% of additional depreciation in year 1 and the balance 50 in year 2. So you claim entire additional depreciation but only in 2 years. That is called as this concept as. I'll repeat that again. What is that? Items that are purchased during the year if put to use for less than 180 days charge additional depreciation only at 10%. That is 50% of 20 in the year of purchase and claim balance in the next year. This is what the department says. So friends, moving on. So only manufacturers can claim additional depreciation, that too only on the eligible plant and machinery. So the question is, what is this eligible plant and machinery? Let's understand what exactly are this eligible plant and machinery. Listen. So what department say, rather than saying what is eligible plant and machinery, department have given a negative list. Department have given a negative list. What do you mean by this? Whatever assets that you are purchasing apart from the following, whatever plant and machinery that you are purchasing apart from the following can be called as an additional or an eligible plant and machinery. So all the plant and machinery apart from those plant and machinery which is given here under can be called as an eligible plant and machinery. So let's see which all are the items under negative list. Starting with the first one, second-hand plant and machineries. You can never treat second-hand plant and machineries as your eligible plant and machinery. So you cannot claim additional depreciation on second-hand plant and machinery, but you can definitely claim additional normal depreciation on second-hand plant and machinery. But additional depreciation you cannot claim. Second one, ships and aircraft. You can never claim additional depreciation on ships and aircraft. Office appliances and road transport vehicles. On office appliances and road transport vehicle, you cannot claim additional depreciations. Plant and machinery installed in guest house, residential accommodation, etc. Whatever the plant and machinery that you have installed in guest house, residential accommodation, etc., you can never claim additional depreciation. Plant and machinery where 100% deduction is already allowed. What are the plant and machinery where you can claim 100%? Say for example, specified business assets that we will learn today. Okay, imagine there are certain category of assets in the year of purchase itself. You can claim 100% of its cost as a deduction. Okay, for example, section 35, scientific research asset, which is under section 35 that we will learn today, or 35 AD, specified business assets. Those assets in the year of purchase itself, you can claim 100% of its actual cost as a deduction. So for those assets, you will not be getting any additional depreciation. And one more thing, you will not be getting any normal depreciation as well for those assets, because already that entire cost is allowed as a deduction. So we will not be getting any normal depreciation as well as additional depreciation over the value of those assets. This is what the department says. Moving on. So which all are the items that are coming under negative list, friends? Number 1, second-hand plant and machinery. Number 2, ships and aircraft. Number 3, office appliances and road transport vehicles. Number 4, plant and machinery installed in guest houses, residential accommodation. Then number 5, plant and machinery where 100% deduction is already allowed. For these assets, you can never claim additional depreciation. This is what the department says. I hope that point is clear for you. So moving on to the next point. What is the next point, friends? So there is a note under that: dumpers, forklift truck used exclusively inside the factory is eligible for additional depreciation. This is actually an important note. Imagine you are using a lorry. Okay, imagine you are using a lorry. You are using a lorry exclusively inside the factory premises. You are using a lorry exclusively inside the factory premises. You are not taking this lorry out. You are, say for example, it's a 100-acre factory. Okay, you are transporting your raw materials to the processing, thereafter to the warehouse. So the lorry, you are using that lorry exclusively inside your factory premises only. For that lorry cannot be called as a road transport vehicle, even though lorries are generally called as road transport vehicle. According to the income tax law, on the value of this lorry, you can definitely claim what? Additional depreciation. You can definitely claim what, friends? Additional depreciation. You don't have to treat that value of that lorry as a road transport vehicle. You can definitely claim additional depreciation on the value of that respective lorry. This is what the department says. So whatever dumpers, like tippers, lorries, etc., then forklift truck. You might have seen forklift truck, a truck that have two hands like this, which is actually used for lifting containers, etc. and all. For those two assets are never considered as a road transport vehicle, and hence you can claim additional depreciation. If it is used exclusively inside the factory, these two are not considered as road transport vehicle, and you can charge additional depreciation. This is what the department says. So these two you can charge additional depreciation. These two are never considered as a normal road transport vehicle, and I hope it is clear for you. So this is all about the concept of additional depreciation, friends. So imagine in our last example, we have computed normal depreciation. Let's accommodate additional depreciation as well in the last example. So imagine this is a factory. And if additional depreciation is allowable, how do you accommodate additional depreciation? So this was the depreciation computation sheet. Hope you remember. This was our normal depreciation sheet. So I'll write normal depreciation over here. Normal depreciation, and now you can claim additional depreciation as well. You can claim additional depreciation as well. How do you claim additional depreciation? On the opening value, you can never claim additional depreciation. On the addition, first addition, 5 lakh. On that first addition, 5 lakh, definitely you can claim additional depreciation at full rate 20%, because it's a generator. It's a generator and you are a manufacturer, and definitely you can claim additional depreciation for that generator value. So additional depreciation on the first is 20% of 5 lakh. So 5 lakh into 20%, and that will be rupees 1 lakh. Can be claimed this additional depreciation in the first case. Then not yet over. On the second purchase is on 5th January 2025. 5th January 2025, your relevant previous year will be 2024-25. Okay, relevant previous year will be 24-25, and 5th January 2025 means less than 180 days. So on that 2 lakh value, you can charge depreciation at 10%. That is 2 lakh into 10% is 20,000. So you deduct these two, and you can write a note, the balance 20,000 rupees allowed in next year, because you can only charge 50% of the additional depreciation in the first year if you are put to use an asset for less than 180 days, and the remaining 50% is allowed as a reduction in the subsequent year. That is what is the concept. So here what you can write a note like this, and you can charge the additional depreciation as well. So how much is the total value of asset before depreciation? 17 lakh. So from 17 lakh, you can claim normal depreciation 225, then again a normal depreciation of 15,000, then additional depreciation of 1,20,000 in total. So the remaining WDV, closing WDV will be 13,40,000. So I hope this example is clear for you. This is how you need to compute the additional depreciation, and I hope this is clear for everyone. So this is how you need to compute the additional depreciation. For a better clarity, I am displaying the screen. So this is how you need to compute the additional depreciation as well as normal depreciation. So friends, please tell me, is it all good, all clear? So please take a note of this. Let me collect some water and come. Please take a note of this, friends. Please take a note of it. Yeah, so hope you have completed it. So, yes. Okay, friends, so let me continue my discussion over the next topic. We have completed the concept of depreciation. So, in a full-fledged examination question, these are the things that you have to focus. What I'm saying is, I'm not covering the entire PGP from top to bottom. What I'm trying to do is, in a full-fledged question, which all are the areas that you have to focus under PGBP rather than you learning from top to bottom. These are the most important areas that you need to focus while learning PGBP. Must revise topics. Moving on to the next one, depreciation is actually computed on the actual cost. What do you mean by actual cost? Actual cost means all the purchase cost and all direct expenses incurred till put to use. So imagine, so when you are computing depreciation, depreciation have to be computed on the value of actual cost. Now the question is, what is this actual cost? So actual cost simply means you take the purchase cost. Along with the purchase cost, you add all the direct expenses that are related to your purchase. Say for example, loading, unloading, transportation, installation, testing, erecting, other costs, other technician cost, etc. All the direct cost until you put to use. Until you put to use that respective asset, everything have to be added along with the actual cost of an asset. on the value of actual cost you charge depreciation as per the applicable rate. It is not only on the purchase cost, but you need to add all the direct expenses in related, which are related to your purchase along with the actual cost. And on the actual cost only you need to compute the depreciation. So actual cost means purchase cost and all direct expenses incurred till put to use. And while one important point is there, what is that? While making payments regarding capital assets, single day payment exceeds 10,000, payment in prescribed modes, account pay check, account pay bank draft, ECS and prescribed electronic modes, if paid in other modes, should not form part of the actual cost of capital asset. Oh my God, what are they saying? Listen, so imagine you are purchasing an asset having a value of 10 lakh, and you are about to make the payment in 2 installments. Installment number 1 on 15th August 2024. On our Independence Day, you are giving the first installment. Then on 15th December 2024, you are giving the second installment. The first installment amount is, imagine, 4 lakh that you have paid in cash. Second installment is, say, 6 lakh that you have paid through bank. Say RTGS, direct credit through bank you have given. So your total cost of asset is no doubt 10 lakh, but you cannot claim 10 lakh as an actual cost. You cannot depreciate the entire 10 lakh, because what the department say, if while making payment which is related to an capital asset, if the single day payment exceeds 10,000, make sure that you have made the payment in prescribed mode only. Which all are the prescribed modes? Number 1, account pay cross to check, account pay bank draft, electronic clearing system, and prescribed electronic modes. These are the 4 prescribed electronic modes. Prescribed electronic mode simply means, say for example, credit card, debit card, RTGS, IMPS, Google Pay, Aadhaar Pay, Beam Pay, etc. are considered as your prescribed electronic modes. So if you are making the payment in any other mode, say especially cash, you will never get that amount paid. You shall never treat that amount paid as a part of your actual cost, and don't depreciate as well. That simply means, in this example, you have paid 4 in cash, 6 through RTGS. You capitalize 6 only and charge depreciation only on the value of the 6. Forget about this 4, because 4 is a 1 day single payment. That 4 lakh is more than 10,000, and the method of payment is otherwise than by way of account pay check, account pay bank draft, ECS or prescribed electronic modes. You hope you got my point. So while making payment in relation to a capital asset, if the single day payment exceeds 10,000, make sure that you have made the payment only by way of these 4 modes. If you are making the payment in any other mode, you can never capitalize it, and don't even think about charging depreciation over the value of that particular portion. I hope you are getting my point. Now, first of all, one important thing from the examination perspective over here, what is the account pay cross check? There are different types of crossing. Okay, simple crossing is there. Account pay crossing is there. Account pay cross check simply means, imagine this as a check. You put 2 lines over here and writing account pay. Okay, and then on the check to pay, there is a column called to pay in the check, and you need to write Mr. Jose, or Mr. JK. You're writing Mr. JK. Then only JK through his account can encash that respective check. This check is normally called as account pay cross check. In examination, if they are simply saying bearer check, or simply saying cross check, these are not account pay checks. Bearer checks, cross checks, etc. are not account payee, and hence if the payment is made through bearer check, 4 lakh given by way of bearer check, not allowed as a part of your actual cost. You cannot claim depreciation over that 4 lakh. Account pay cross check means it is account payee only. Hope you got my point. Whenever you hear the word check, don't jump into conclusion that it is account pay always. If it is an account pay check, then they will clearly mention that it is an account pay cross check. If they simply say bearer check or cash check or simple cross check, that is never considered as an account pay check, and you will not treat it as a prescribed mode of payment. And I hope you got my point clear. Now, Moving on to the next one. So this is all about your depreciation, actual cost and other things. So don't forget these rates you should study. That is for building. What was the rate? 10%. For furniture and fittings, what was the rate? 10%. For intangibles, what was the rate? 25%. For ships, what was the rate? 20%. Plant and machinery subcategory motor vehicle, what was the rate? 15%. Computer and peripheral, what was the rate? 40%. Windmill, 40%. Pollution control equipment, 40%. Book, 40%. EV, 40%. General rate, 15%. So these things you should remember. Yes. So moving on to the next point, friends, the next section, that is section 35, scientific research expenses. Imagine I have a research and development department. Imagine I'm a company, I'm focusing on new technology, innovations, etc., etc., etc. And I have a own R&D, that is research and development department. Okay, I have an in-house research and development department. There is a separate wing where my scientists and other persons are doing experiments, etc., etc., and they are trying to find something new. So whatever the cost that I've incurred for this in-house research and development, I can claim it as a deduction. So scientific research expenses can be called as an in-house research expenses. In-house means I myself have a R&D, and whatever the cost that I'm incurring and related to my R&D is allowed as a deduction under section 35. That is what the department say. So please listen. Please listen. So whatever R&D expenses that I'm incurring in my research and development department, I can claim it as a deduction under section 35. So starting with, you can divide that expenditure into two. Number one, revenue nature expenditure. Number two, capital nature expenditure. So you can divide that expenditure into two, friends. Number one, revenue nature, and number two, capital nature. So listen, revenue nature expenses simply means, I'll give you some examples for the revenue nature in-house scientific research expenses. Imagine you are paying salary to your scientist, salary to your support staff, printing and stationery, current bill, power, fuel, traveling charges, etc., etc. Then rent related to your building, then rent related to your plant and machinery. All those revenue nature expenditures are allowed as a deduction under 35, and you can claim capital nature expenditure also as a deduction. So first we will focus on the revenue nature in-house scientific research expenses. So whatever the in-house scientific research expenses can be, as I've told you, divided into two. Number one, revenue nature, and number two, capital nature. Under revenue nature, you can divide that into two again. That is pre-commencement revenue nature expenditure and post-commencement revenue nature expenditure. Tell me, what is pre-commencement revenue nature expenditure? Listen, very simple. Say you have an R&D. You have a research and development department. Okay, you have an R&D, research and development department. In that, you are incurring some revenue nature expenditure. That can be divided into two. That is pre-commencement and post-commencement or after commencement. What is pre-commencement? Imagine I'm a company. I'm about to start a new manufacturing. Say I'm about to market a mobile phone. I'm about to manufacture a mobile phone. So before I launch my product, I should have some core competency. That means I should have some unique selling point which my competitors does not have. Then only I'll be able to grab the market compared to my competitors. Yes or no? So imagine, even before starting my manufacturing of mobile phone, I'm focusing on an R&D because I want to come up with something new. So I've told my scientists, you go research and find out something. If you find out something, only I'll be starting my company. So even before I start my manufacturing activity, there can be a scientific research expenses. Okay, 1 second, friends. Yeah, even before I start my manufacturing activity, I will be so much concerned about my technological advancement. So what I will do, I'll tell my scientists to come, go, find out something. Then only I'll be starting my expenses or starting my manufacturing. So all the expenses that I incur, which are in revenue nature, even before my manufacturing activity starts, are called as a pre-commencement revenue nature expenses. Simply means whatever expenses that I incur in revenue nature, which are related to scientific research, before I commence my business, is called as what? Scientific research revenue nature expenses. This is pretty simple. There is nothing complicated in this. Alright. So listen, pre-commencement. So pre-commencement revenue nature expenses. So in the pre-commencement phase, there is nothing called the PGBP because you haven't even started your business. So what you need to do is, in the pre-commencement phase, whatever expenses that you are incurring, what you need to do, only two types of expenses, whatever expenses that you incur, out of that, only two types of expenses you can accumulate and claim these two types of expenses as a deduction in the year of commencement. So three things are there. Number one, if you are incurring a pre-commencement revenue nature scientific research expenses, in the pre-commencement phase, there is nothing called a business because you haven't started your business. So you accumulate the pre-commencement revenue nature expenses, then you claim it as a deduction in the year of commencement under section 35. This is what the department says. But you cannot accumulate all revenue nature pre-commencement expenses and you cannot claim all revenue nature pre-commencement expenses as a reduction under 35. So what department say? Do one thing, only these two expenses that you incur in the pre-commencement phase, you accumulate and claim it as a reduction in the year of commencement. Which all are these two? Number one, payment of salary to research personnel. Whatever salary that you are paying to your research personnel, you can accumulate and claim it as a reduction under section 35. Number two, purchase of raw material. Whatever expenses that you have incurred for purchasing raw material in the pre-commencement phase, you can accumulate and claim it as a reduction under section 35. So two things, payment of salary to research personnel and purchase of raw material. These two expenses that you have incurred in your pre-commencement phase is allowed as a deduction. You accumulate these two and claim it as a deduction under section 35. This is what the department say. So payment of salary to research personnel and purchase of raw material, these two incurred in the pre-commencement phase, you accumulate and claim it as a deduction under section 35. So, and that too, one more thing is there, these two incurred 3 years immediately preceding the date of commencement, allowed as a reduction in the year of commencement. So these two expenses that you have incurred when that too 3 years immediately preceding the date of commencement of business is allowed as a reduction in the year of commencement. That means you have commenced your business on 1st April 2024 is the date of commencement. Date of commencement. Okay, whatever salary that you pay to your scientist, okay, research personnel, scientist, and whatever the purchase of raw materials, cost that you have incurred, 3 year immediately preceding the date of commencement. 3 year immediately preceding means from 1st April 2021, that is 21-22, 22-23, 23-24 is the 3 years. Whatever cost that you have incurred in these 3 years, these two costs in these 3 years, you accumulate and claim it as a deduction. In which year? In 24-25. That is your year of commencement of business. This is what the department says. So if they are talking about research expenses, that too revenue nature research expenses, this is what you are supposed to do in your exams. So all the payment of salary to research personnel, purchase of raw material, incurred 3 years immediately preceding the date of commencement, allowed as a reduction in the year of commencement. Now, salary normally includes perquisites, bonus, basic, DA, allowances, other allowances, gratuity, pension, etc. But in the pre-commencement phase, salary to research personnel is normally allowed as a reduction, but that salary component specifically excludes what? Perquisites. So salary above means in the pre-commencement phase, when you are giving salary to your research personnel, that specifically excludes what, friends? Perquisites. You will not be getting whatever perquisites that you have offered to your research personnel as a deduction while computing your business profits. So that is what they are saying. It's pretty important. So salary in the pre-commencement phase specifically excludes what, friends? Perquisites. This is what the department says. Moving on, after commencement. So this is all about the pre-commencement phase. Now we will talk about the post-commencement phase. Imagine after commencement, you started your business. After commencement, any expenditure allowed as a deduction in that respective year itself. So once you have commenced your business, okay, once you have commenced your business, whatever expenses that you have incurred, is allowed as a deduction in that year itself. That's what the department says. So very simple, pre-commencement phase, you accumulate those two. That two incurred 3 years immediately preceding the date of commencement as a deduction in the year of commencement. Second one, after commencement, once you commence your business, that revenue nature expenses which are related to your scientific research is allowed as a deduction in the year of expenditure itself. That's what they are saying. There is no restriction. Whatever revenue nature expenses, including salary, power and fuel, printing and stationery, rent, whatever that you have incurred is allowed as reduction in that respective year itself. No restriction, nothing. But the only one thing is that expenditure should be connected to your scientific research. This is what the department says. So this is the treatment of the revenue nature scientific research expenses. And let's now focus on the capital nature scientific research expenses. Capital nature scientific research expenses simply means whatever expenses that you have incurred for your scientific research which is in capital nature. Say for example like purchase of building, purchase of land, purchase of plant and machinery, whatever capital nature expenses. Normally the capital nature expenses are capitalized and you charge depreciation. But section 35 what they are saying is don't capitalize and don't charge any depreciation. Rather what you need to do is you simply claim that entire capital expenditure as a deduction under 35. Oh my god, rather than simply capitalizing and charge depreciation, you claim that entire capital expenditure as a deduction under section 35. So capital expenditure excludes expenditure incurred on land. So if you are purchased the land and you are using that particular land for the purpose of your scientific research, the cost of land is never allowed as a deduction. Apart from cost of land, all other capital expenditures are allowed as a deduction under section 35. Say for example, plant and machinery, building, etc. you can claim, but never for land. You will not get expenditure that you have incurred on land as a deduction under section 35. Now, again, capital nature expenditure can also be divided into two, pre-commencement and post-commencement. Now, what is pre-commencement? All capital expenditure except cost of land incurred 3 years immediately preceding the date of commencement allowed as a deduction in the year of commencement. Imagine you have incurred a scientific research expenditure. Imagine you have incurred a scientific research expenditure which is in capital nature before the commencement. Okay, which is in capital nature before the commencement. You simply do one thing, whatever capital nature expenditure that you have incurred, that too within 3 years immediately preceding the date of commencement. Within 3 years immediately preceding the date of commencement is allowed as a deduction under section 35. This is what the department say. Whatever capital nature expenditure that you have incurred within 3 years immediately before the date of commencement, you accumulate it and claim it as a straightaway deduction under section 35 in the year of commencement. Just like our salary, 3-year expenditure just before the commencement of your business, you accumulate and charge it as a deduction under section 35. That's what you are saying. And again on this capital expenditure, don't charge any depreciation because we are giving you a 100% deduction for the entire capital expenditure. Now, parallelly, you cannot claim again depreciation on the same value of asset. Hope you are able to follow what I'm saying. Now, after commencement, if you are incurring any pre-commencement or post-commencement expenditure, it is allowed as a reduction in that year itself. So, in-house scientific research, capital nature expenses. If it is related to pre-commencement, then you accumulate all the capital expenditure incurred 3 years preceding the date of commencement, allow it as a reduction in the year of commencement. If it is post-commencement, allow it as a reduction in that year itself. Capital expenditure excludes land, expenditure of land. You will never get a deduction for the expenditure on land. This is what is the treatment is. So I hope section 35 is clear for you. And now there are some more notes. So imagine friends, when you are charging your capital expenditure into your profits, okay, you will not be having that much profit to absorb all the capital expenditure that you have expended. Yes or no? Your profits will be comparatively less and capital expenditure will be comparatively high because capital expenditures are actually huge in nature. So, if you have any unabsorbed capital expenditure on scientific research, what to do? You carry forward to this particular expenditure to unlimited subsequent years for set off. Imagine if you have unabsorbed capital expenditure on scientific research, you carry forward this unabsorbed capital expenditure on scientific research to unlimited subsequent years for set off. That means you can carry forward that unabsorbed capital expenditure to the next year after that. So whenever you have profits and whenever you are completely absorbing it, you can keep on carry forwarding that particular unabsorbed capital expenditure on scientific research to the future years. There is no time limit for the carry forward. And one more thing is there. Imagine you have unabsorbed depreciation. What is unabsorbed depreciation? Imagine your depreciation under section 32 that we have learned earlier, 32 is 10 lakh. And your current year income is 0. You don't have any current year income, you have unabsorbed depreciation that is 10 lakh, but your current year income is 0. So you cannot charge this depreciation because you don't have income. So what to do with this depreciation? You can carry forward this depreciation to unlimited subsequent years. This is what the department say. Similarly, here also what you can do is unabsorbed capital expenditure on scientific research can be carried forward to unlimited subsequent years. There is no time limit for the set off and carry forward. You can keep on carry forwarding it to future years. This is what the department says. So section 35, this is all about section 35, and one more thing is there under section 35. What is that? So right now what we have discussed is all about in-house scientific research expenditure. In-house scientific research expenditure under section 35. You tell me what is in-house? You have an R&D by your own. Imagine you are giving donations. You are giving donations to these four. There are 4 entities listed out here. You are giving donations to these 4 entities. That donations are allowed as a deduction again under section 35. This is the second part of 35, deduction for amount contributed to outside agencies. So section 35 have 2 parts. Part 1, whatever the in-house scientific research expenses that you are incurring is allowed as deduction in part 1 by categorizing it as revenue as well as capital. And part 2, what is part 2? Deduction for amount contributed to outside agencies. If you are giving donations to outside agencies, you can claim deduction for that donations as well. And let's understand part 2 as well. Alright, so let's see what exactly is part 2. Part 2, what is the first category of donation? You are donating any amount. You are donating any amount. You are donating any amount to a notified approved research association, college, university or other institution which does approved scientific research. Imagine you are donating any amount to a notified approved research association or a college, university or other institution which does scientific research. So you are donating some amount to those institution which does scientific research. Whatever donation that you have given is fully allowed as deduction. Point number 1. Point number 2, you are giving anything to approved Indian company for scientific research. You are giving anything to an approved Indian company for what? For scientific research. You are giving any amount to an approved Indian company for scientific research. That also is allowed as a deduction under section 35. Listen. You are donating to an Indian company which does scientific research. That is also allowed as a deduction under section 35. Number 3, you are giving any donation to a notified research association, college, university, institution, etc. which does research in social science or statistical research. You are giving any donation to research association, college, university, institution, etc. which does research in social science and statistical research. Very simple. 3 types of donations. And one more is there. Let me cover that also. You are given any donations to a national laboratory or IIT, Indian Institute of Technology, for approved scientific research programs. So pretty simple, friends. If you are any person giving donations to these 4 parties, whatever the amount donated is fully allowed as a reduction under section 35. Category number 1, notified approved research association, college, university, other institutions which does scientific research. Number 2, you are donating something to an Indian company. Imagine JK Limited is a company. This company is donating to a notified approved research association, college, university, other institution which does scientific research. JK Limited, whatever amount donated, fully allowed as deduction under 35. Second one, JK Limited is donating something to Indian company for scientific research. Whatever JK Limited donated to the Indian company for scientific research, fully allowed as deduction. Number 3, JK Limited donated something to notified research association, college, university, institution which does social science or statistical research. JK Limited is donating to an institution which does social science or statistical research. Fully allowed as deduction. Section 35. And final item, JK Limited has donated something to National Laboratory or IIT for their approved scientific research programs. Yeah, I'm donating, I'm funding it. No problem, I can claim that entire funded amount as a reduction under section 35. So these points are pretty simple. You don't need to worry about anything over here. So section 35 we divided into two: in-house scientific research expenses and outside contributions. I hope you got a grip over these provisions. So friends, can you please respond? Are you able to follow whatever I've said? Please respond in the chat, friends. Is everything clear? Please respond. All good. Okay, perfect. Yeah. So moving on, friends. Moving on to the next one, that is section 35AD, and let's understand what is that deduction. Section 35AD. So that is said to be deduction for specified business. Imagine if you are a specified business. If you are a specified business, then what is the advantage? For a normal person, if they are incurring any capital expenditure, they need to capitalize it. They need to capitalize it and charge depreciation under section 32. Yes or no? But if you are a specified business, if you are a specified business, then what you can do? You can claim all the capital expenditures as a straightaway deduction under section 35 AD. This is what we are about to discuss right now. If you are a specified business, whatever the capital expenditure that you are incurring is allowed as a deduction under section 35 AD. Straight away deduction. You don't need to do anything else. Don't capitalize. Don't charge it as a depreciation. Straight away claim it as a deduction under 35 AD. This is what the department says. All right, let's see which all are the specified businesses. Starting with item number 1, or rather than which all are the specified businesses, let me start with their specialities. Okay, if you are a notified specified business under 35 AD, 100% deduction for capital expenditures. You will be getting 100% deduction for all the capital expenditures except for excluding the expenditure for land, goodwill and financial instrument. Imagine you are purchasing a land or a goodwill, or you have purchased a financial instrument. These three are capital expenditures. Yes, no doubt. But you cannot claim 35 AD deduction for these three. Apart from these three, if you are purchasing a building, purchasing a plant and machinery, purchasing any other intangible asset, purchasing any other capital asset like furniture, you can claim 100% deduction for all other capital expenditures. Apart from these three, if you are a specified business, you can claim 100% deduction for all other expenses, capital expenses. Don't charge any depreciation afterwards. You simply claim everything as a reduction under 35 AD. So the point is, which all are the specified businesses, list of specified businesses. You need to study this. You need to study the list of specified businesses one by one. Starting with the first one, cold chain facility. If you are a cold chain facility, running a cold chain facility, you are a specified business. Number 2, warehousing for agricultural products. You are actually running a warehouse where you are storing agricultural produces. Definitely you are a specified business and claim 100% deduction for all the capital expenditures. Number 3, cross-country oil pipeline network that is basically for petroleum and natural gas and crude. So this is not petroleum, natural gas, crude extraction. What they are saying is you are having a oil pipeline network distribution business. Basically, it's a distribution business, oil pipeline network. That through cross country. So from India to Bangladesh, India to Sri Lanka, India to Myanmar, India to Bhutan, India to Nepal, etc. You have a petroleum, natural gas, crude distribution, that too by way of pipeline. Petroleum, natural gas, crude, oil pipeline network distribution, that too cross country. You are a company which distributes oil in a cross country through pipeline network. That business is considered as a specified business again. Number 4, 2-star or above category hotels, Taj Malabar, then Taj Vivanta, etc. are considered as, or ITC, etc. are considered as 2-star or above category hotels. So these hotels are specified businesses. Number 5, hospital with 100 patient beds. You are a hospital where you can accommodate 100 patients or more than 100 patients. Definitely you can claim deduction under 35AD. Item number 6, building housing projects under slum rehabilitation or affordable housing. So if you are a person running a housing project. So you are a person who develops housing projects. You are a person who develops housing project under slum rehabilitation or affordable housing scheme. Then you are considered as a specified business. Then next one, if you are a fertilizer manufacturer, you will be considered as a specified business. If you are inland container depot, ICD means inland container depot. Inland container depot, CFS, container freight station. So the place where these containers are stored is normally known as inland container depot. And what is CFS? Container freight station. That means that logistics business where you need to transport the containers. So if you are an inland container depot or a container freight station, you will be considered as a specified business. Then next one, production of honey and beeswax. If you are a person who is into the production of honey and beeswax, you will be considered as a specified business. Next is warehousing of sugar. You are a person who warehouses sugar. Basically, sugar is not an agricultural produce. Okay, sugar cane is an agricultural produce. If you are a person who warehouses sugar, that is also considered as a specified business. The next one, semiconductor manufacturer. If you are a person who manufactures semiconductors, you will be considered as a specified business. Then slurry pipeline for transporting iron ore. If you are a person who transports iron ore by way of slurry pipeline, again you will be considered as a specified business. And finally, if you are an Indian company who is developing infrastructure like road, rail, bridge, etc., you will be considered as a specified business. So these 13 businesses are normally considered as specified businesses. In 6, there are 2 categories. Okay, number 1, you are a builder which develops housing under slum rehabilitation or affordable housing scheme. Both are considered as specified businesses. And you tell me what is the advantage of running a specified business? You can claim 100% deduction for all the capital expenditures, excluding expenditure for land, goodwill and financial instrument. Now, there are a few notes that you should know. The first note under 35AD is pre-commencement expenses. Imagine you are incurring a capital expenditure before the commencement itself. What to do? Nothing to do. Capitalize it in the books of accounts and claim deduction under 35AD. It's not like section 35, scientific research expense. In scientific research expense, what I've told you is whatever expenses that you are incurring 3 years immediately preceding the commencement have to be accumulated and claim it as a reduction under 35. This is what we have learned under 35, scientific research. Here it is not like that. Here what they are saying is whatever expenditure, capital expenditure that you are incurring, irrespective of your pre-commencement period, whether it is before 3 years, whether it is before 5 years, 6 years, etc., you do one thing, you capitalize it in your books of accounts in the year of commencement. In the year of commencement, there is no restriction. You simply capitalize everything into your books of accounts and claim deduction under 35AD. There is no 3-year restriction over here. Okay, now moving on to the next point. Assessee claimed deduction under 35AD cannot claim deduction under 10AA. What is 10AA? And under chapter 6A C heading. What is chapter 6A C heading? Imagine 10AA is a deduction 10AA is a deduction for those units or businesses. If you are in ZES, Special Economic Zone, imagine you have started a unit in ZES, Special Economic Zone. Then under section 10AA, there is an advantage. You can claim 100% deduction for all your export profits for 15 years. Listen, if you are a person who started operating in ZES, SEZ, what is SEZ? We call it a Special Economic Zone. If you have started a business in Special Economic Zone, then you can claim deduction under 10AA for 15 years. You can claim deduction for 15 years. So listen, how do you claim deduction? Very simple. For the first 5 years, you can claim 100% of your export profit as a deduction. That means entire export profit is exempted for the first 5 years. Then the second set of 5 years, that means from year 6, 7, 8, 9 and 10, second set of 5 years, you can claim 50% of export profit. You can claim 50% of export profit as a deduction. Then in the third set of 5 years, that means 11, 12, 13, 14 and 15. In the third set of 5 years, you can claim 50% of export profit or amount transferred to ZES reserve, whichever is lower, as a deduction. So first 5 years, you can claim 100% of the export profit as a deduction. Second set of 5 years, you can claim 50% of the export profit as a deduction. And final set of 5 years, you can claim 50% export profit or amount transferred to ZES reinvestment reserve account, whichever is lower, as a deduction. Now, what is the relevance of this 10AA over here? Very simple. Very simple. I'll give you an example. Okay. If you are a fertilizer manufacturer, imagine you are a fertilizer manufacturer. You are a specified business. And this fertilizer manufacturer is located in ZES. They are mainly into exports. They are located in ZES. They are mainly into exports. So the question is, you are eligible under 35AD, specified business. You are eligible under 35AD as well as you are eligible for 10AA deduction. You are eligible for 35AD as well as you are eligible for 10AA. Which one to claim? That is your choice. If you have claimed 35AD, no 10AA. Or if you have claimed 10AA, no 35AD. It is normally like that. It is your choice which one to claim, but you can only claim one. If you are a person claims 35AD for the same business, you cannot claim 10AA. If you are a person claiming 10AA for the same business, you cannot claim 35AD. This is what the department say, which vice versa. Imagine there is one more point in relation to this. Imagine there is a company called JK Limited. I have two divisions. Division 1, fertilizer manufacturing. Say it is in Chennai. Fertilizer manufacturing, it is in Chennai. And division 2, say it is software export, which is in ZES. So division 1, fertilizer manufacturing, which is in Chennai. Division 2, software export, which is in ZES. Two divisions for JK Limited. For this division, I can claim 35AD. No problem. For the second division, I can claim 10AA. For the same division, I cannot claim both. If I have separate businesses, and for one business I can claim, even though it is under a same person, for one business I can claim 10AA, and for the other business I can claim 35AD. There is absolutely no problem. Absolutely no problem. So for the same business, you cannot claim both. That means if the fertilizer manufacturing is in ZES, I have only one business, one division. That division, I cannot claim both. If I have separate division, one in ZES and the other one is specified 35AD and ZES 10AA, no problem. Likewise, cannot claim deduction under chapter 6A C heading. For your inter, there are 3 C heading deductions. 80JJAA, deduction for creating additional employment opportunity. 80QQB, that is deduction for royalty if you are a book author. 80RRB, deduction for royalty on patent. So if I have a person and I have a business and I have claimed 35 AD on that business, I cannot claim either 80 JJAA or 80 QQB or 80 RRB from the same business, because I can claim either 35 AD or chapter 6A C heading deduction. It is not your 80C, 80D, 80DD, etc. That are normal heading deductions. Under chapter 6A, there are A heading, B heading, C heading. C headings actually starts from 80IA onwards. And for your inter syllabus, there are only 3 C heading deductions: 80 JJAA, 80 QQB, and 80 RRB. So the point is, if I am claiming 35 AD, I cannot claim 80 QQB, I cannot claim 80 RRB, I cannot claim 80 JJAA. Or if I want to claim 80 JJAA, go claim 80 JJAA, don't claim 35 AD. So this is what they are saying. From the same business, if you have claimed 35 AD, no 10 AA, no chapter 6A C heading. For the same business, if I have claimed 10 AA or chapter 6A C heading, I cannot claim 35 AD. It's vice versa. Which one to claim? That is your choice. So from same business or vice versa, this is what I have written it over here. So I hope my point is clear. Moving on to the next point, friends, specified business loss. So what is the greatest advantage of specified business? Specified businesses can claim 100% of their capital expenditure as a deduction. Yes or no? So when they claim 100% of their capital expenditure as a deduction, they will definitely end up in loss, because capital expenditures are huge and you will not be having profits that much, especially in the first initial years. Yes or no? So if you are a specified business and the computed figure is a loss, you cannot adjust that loss with your normal business. Imagine I have textile business. I have textile business having a profit of 10 lakh. And I have specified business having a loss of 12 lakh. I have specified business having a loss of 12 lakh. Can I claim this 12 lakh loss from my textile business profit? The answer is no. I need to carry forward this 12 lakh loss to the subsequent year, next year, because I can claim specified business losses only with specified business profits, not with any other normal profit. Are you all with me? So the point is very simple. Specified business losses have to be carried forward to the future. And how many years can I carry forward? Unlimited years. There is no restriction for the carry forward that you can do. So specified businesses can be carried forward to unlimited subsequent years, until otherwise you fully claim it off. This is what the department say. So can set off only against income from specified business. So in next year, I have specified business profit. Imagine 14 lakh. Then I can set off this carry forward, brought forward loss of 12 lakh with the next year profits. Or even this year, I have one more specified business and I'm having profit. Then I can adjust. The point is, I cannot adjust specified business loss with the normal profit. This is what the department says. And such losses can be carried forward indefinitely. That is another point worth noting. So tell me, friends, is this much clear? So what we have learned is 35 AD, that is related to specified businesses, and I hope this much is clear for you. Tell me, is this much clear? All good, all good. Excellent, excellent. Yes. All right, friends. So That is all about section 35 AD. So moving on to the next important deduction, that is section 35 DDA. Let's understand what is section 35 DDA, that is voluntary retirement compensation paid. Imagine you are a company or you are an employer. One of your employee have retired before his retirement age. Say his retiring age is 60 and that employee have retired on say 50. So he have retired before his retirement age, and this is normally called as voluntary retirement. So when your employee is voluntarily retiring, you need to pay him a compensation which is called as voluntary retirement compensation. No, normally we will say VRS payment. Voluntary retirement compensations are actually a cost for the employer, and hence it is allowed as a deduction under section 35 DDA, but there is a problem. Can claim it as a deduction in 5 equal annual installments. Very simple. If you are paying voluntary retirement compensation, you can claim that compensation as a deduction in 5 equal annual installment. That means the employer can claim it as a deduction in 5 equal annual installment. You can claim it as a deduction in 5 equal annual installment. That is the point. So if you are a person who is claiming or who have paid this VRS, you can claim that VRS in 5 equal annual installment. Imagine in 24-25 you paid 10 lakh, then 10 divided by 5, 2 lakh each in 24-25, 25-26, 26-27, 27-28 and 28-29, 5 years. In the upcoming 5 years, you can claim it as a reduction. And one more thing is there in examination, if they have debited this entire 10 lakh to the net profit, what you need to do? You need to add back 4/5 because you can only claim 1/5 in 1 year. So if they have debited the entire 10 lakh in the P&L account in the examination question, what do you need to do? Add back 4/5. That means if they have debited this entire 10 lakh, then you need to add back how much? Every year you will be only getting 2 lakhs deduction, right? So you need to add back 8 lakh. You need to add back 8 lakh, then only you can claim it as a deduction. This is how you need to treat it. So I hope it is clear for you. Yes, this is all about 35 DDA. Pretty simple item, then there is nothing complicated under section 35 DDA. So I hope this much is clear, friends. So we'll do one thing, friends. Let's go for a small break. Okay, let's go for a small break and you can have your breakfast or something and you have a tea and come back. We will continue exactly by 9:30. Okay, half an hour. You can have your breakfast and come. So we will continue our live exactly at 9:30 a.m. Not 9:30, sorry, it's already 10. I'm sorry. We'll continue at 10:30 a.m. Okay. We'll continue our live on 10:30 a.m. Go have your breakfast and come back. So I'll write it over here. Continue at 10:30 a.m. Okay, have your breakfast, have a tea, then relax and come. Okay. So in the meanwhile, if you have any doubts, you post your doubts in the comment. I'll definitely address it. Okay. In the meanwhile, if you have any doubts, you can post all of your doubts in the comment box. I'll address all of your doubts. Yes, friends. So tell me, am I audible? Friends, please respond. Am I audible? What's the status? All good, right? Okay, so let's continue. I hope my audio, video, everything is clear. So can you please comment my audio, video, everything? Is it all clear? Yeah. Okay. So let's start, friends. Perfect. Okay, so where were we? We were discussing sections, deductions from 35DDA was the last section that we have discussed. Now moving on to 36, that is other specified deductions. So let's understand which all are the other specified deductions that you should know. Starting with the first one, insurance premium on stock in trade and stores. Imagine you have taken an insurance. You have taken an insurance for your stock or stores. So whatever insurance premium that you have paid is allowed as a reduction under section 36. You have taken an insurance for your stores as well as for your stock. Whatever the insurance premium that you have paid on your stock in trade as well as stores is allowed as a reduction under 36. There is nothing complicated, nothing more. Moving on to the next one, health insurance premium paid by the employer on behalf of employees. You are paying health insurance premium, say as an employer. Okay, imagine you are a company owner and for your employees you have taken a health insurance and you are paying premium for the benefit of your employees' health insurance. Whatever premium paid by the employer for the benefit of their employees, health insurance benefit of their employees is fully allowed as a reduction under section 36. Moving on to the next one, bonus or commission paid by the employer to the employee. If the employer is paying bonus or commission, then the entire bonus or commission paid by the employer to the employee is fully allowed as deduction under section 36. So three things. Number one, insurance premium paid for stock in trade and stores. That means consumables. Number two, health insurance premium paid by the employer on the behalf of the employees. Number three, bonus or commission paid by the employer to the employees. All these three things are deductible under section 36. Not over. Next one, interest on borrowed capital. Imagine you have taken a loan for your business or profession. The interest that you are paying for that particular loan. Imagine you have taken a loan for your business or profession. That interest that you are paying for the loan is fully allowed as a reduction under section 36. Whatever interest that you have paid for your business, whatever interest that you have paid in respect to a loan which is taken for your business is fully allowed as a deduction under section 36. So listen, when you claim this interest as a deduction, there are a few things that you have to be careful with. Number one, if the loan is taken for acquiring a capital asset, then you have to be careful. So listen. Say for example, you have taken a loan. Okay, you have taken a loan for your business or profession. You have taken a loan for your business or profession. Okay, and this loan interest that you normally pay is allowed as a reduction under 36. The only one thing that you have to be careful with, if you have taken a loan for buying a capital asset, if you have taken a loan for buying what, friends? For buying a capital asset, then you have to be little bit careful. What they are saying is interest payable up to put to use of capital asset shall be capitalized and added with the actual cost of asset. So in the previous session, I have told you about the actual cost. What is actual cost? all the cost that is related to purchase of a capital asset said to be actual cost. Say for example, purchase cost, loading charges, unloading charges, installation charges, all these costs will form part of the actual cost. Now one more thing will come. What is that? Imagine on 1/4/2024, you have purchased an asset by expending 10 lakh. You have purchased an asset by expending 10 lakh and the rate of interest say 12%. Rate of interest say 12%. You have purchased an asset by taking a loan and the rate of interest for this loan is how much, friends? 12%. Now listen, this asset you installed this asset on 1st January 2025. So you put to use, that means installation completed on 1st January 2025. So as you all know, you have taken this loan of rupees 10 lakh at a rate of 12% interest, and from April to December, you haven't put to use that asset because there was some technical problem or you require some installation period or something like that. So all the proportionate interest of that loan which is initially taken for purchasing that capital asset up to put to use of that capital asset shall be fully capitalized. That simply means the rate of interest or the interest from April to December. April to December means 9 months. How much is the total interest? 10 lakh is the total loan amount. 12% is the interest. So the total interest will be 1,20,000. Out of this 1,20,000, 9 months interest. So 9 by 12 into 1,20,000. 9 months interest means 90,000 rupees. This 90,000 rupees have to be capitalized along with the actual cost of the asset. Along with the actual cost of asset. This is what the department says. Are you with me? Now, the remaining interest, how much is the remaining interest? That means 3 months interest. Your PY will be 24-25. So 3 months means from January, February and March, 3 months interest is around 30,000 rupees. That 30,000 rupees you can claim as a reduction under 36. So what they are saying is, if you have taken a loan for acquiring a capital asset, the proportionate interest up to put to use of that respective capital asset have to be capitalized along with the actual cost of the asset. All the remaining interest you can claim as a reduction under section 36. I hope you got my point. So the interest on loan, provided the loan have taken to acquire or construct a capital asset, whatever the interest, proportionate interest that you have paid up to put to use of that respective capital asset have to be capitalized. That simply means the cost of asset is 10 lakh. The entire 10 lakh you have taken on loan. So what is the value to be capitalized? 10 lakh plus 9 months interest. 9 months interest is 90,000. So 10 lakh 90,000 shall be the amount to be capitalized. And you charge depreciation on this 10 lakh 90. You charge depreciation under section 32 on this 10 lakh 90. This is what the department say. The remaining 30,000 you can straight away claim as a deduction under 36 itself. This is the concept and I hope it is clear. This is related to section 36. I hope everybody got the point. And now moving on to the next one. And what is the next point? The balance period interest shall be allowed as a deduction under section 36. Whatever the balance interest you have, that is allowed as a deduction under 36 itself. Moving on to the next one. Contribution to Provident Fund and other welfare fund. Imagine you are an employer and you are contributing to Recognized Provident Fund, RPF, Recognized Provident Fund. So Recognized Provident Fund is a retirement benefit. Both the employer and employee will contribute to the Recognized Provident Fund. You all know all the concept. Now the point is, when the employer contributes some money to a Recognized Provident Fund, to RPF, for the employer it is an out-of-pocket expenditure. Out-of-pocket expenditure, and the employer can claim that out-of-pocket expenditure as a deduction under section 36. This is what we are about to discuss right now. If you are an employer and you have paid contribution to Employee Provident Fund, you are an employer and you have paid contribution to the Employee Provident Fund, you can claim that entire contribution as a deduction. That means the employer contribution as a deduction. So contribution to Provident Fund and other funds. Let's see. Employer contribution. What to do? For the employer contribution means the contribution that the employer have paid from his pocket. that is an expense for the employer and he can claim it as a deduction. So allowed as a deduction based on actual payment basis under 43B. 43B we will discuss later. We will discuss later 43B. Okay, so the employer contribution out of pocket expenditure is allowed as a deduction under section 36. Under section 36. Now, to claim deduction, it have to be paid on or before due date of filing return. That simply means, imagine, I'll make use of one single example. Okay, so both the employer and employee will contribute the recognized provident fund. Imagine there is an employer and employee is Mr. A. Mr. A is the employee. So the employer, say, every year or every month pays 12,000 rupees as salary. 12,000 per month as salary to the employee. Okay, the employer, say, imagine, pays 2,000 rupees to provident fund. 2,000 rupees to the provident fund, to the recognized provident fund for the benefit of employee, for the benefit of Mr. A, who is the employee, from his pocket. This 2,000 is a cost for the employer and he can claim it as a deduction under section 36. It is as simple as that. Now, there is one more point. The second point, what are they saying? Employee contribution. What is that? Treated as income in the hands of employer and allowed as deduction only if it is paid to the respective fund on or before date as per the respective act. Okay, what does that mean? Imagine when the employer pays monthly salary to the provident fund. In the provident fund, both the employer as well as the employee have to contribute. So when the employer pays monthly salary to the employee, he will deduct employee's contribution also. Employee's contribution, that means Mr. A's contribution have to be deducted. Say 2,000 is Mr. A's contribution and this will be deducted and Mr. A will be getting only 10,000 rupees. Mr. A will be getting only 10,000 rupees as salary. And this 2,000 will be paid by the employer to the recognized provident fund. So you tell me how much is the total amount that the employer pays every month? It is 4,000 rupees. How can it be 4,000? 2,000 from his own pocket and 2,000 will be deducted from the salary of the employee and it will be paid to the recognized provident fund. This is how that RPF works. Now, this 2,000 is the employer's cost and it is allowed as a deduction under section 36. Now, the next 2,000, that means the 2,000 that is deducted from the employee's monthly salary is not from the pocket of the employer. And hence normally it is not allowable as a deduction. But what Act says, whenever the employer deducts that particular 2,000 rupees from the monthly salary of employee, whenever the employer deducts that 2,000 from the monthly salary of employee, that 2,000 will be considered as income of the employer. 2,000 will be considered as income of the employer, and when the employer makes that 2,000 rupees payment to the recognized provident fund, he can claim it as a deduction. My God, what is this? Basically, it is not your income, not your expense. That 2,000 is employee's contribution which is deducted by the employer when he pays the monthly salary. Yes or no? That employee's contribution deducted by the employer shall be considered as income of the employer, and thereafter when the employer makes that payment to the respective fund, he can claim that 2,000 as a deduction. Basically, it is not income of the employer, not expense of the employer, but it have to be treated as income as well as expense. Why? Because the income tax department says to the employer that every employer is supposed to correctly deduct the portion and correctly make the payment to the recognized provident fund account on or before its due date. So when you deduct it, we will consider it as your income. When you pay it to the respective fund, we will allow you to claim it as your deduction, so that there is no bearing for you. So that we know that you will be correctly deducting that employee's contribution and you will be paying it to the respective provident fund on or before its due date. So to make this administration effective, to make this administration a timely basis, or to make this payment on a timely basis, income tax department say whenever you cut it, we will consider it as your income, and whenever you make the payment to the respective fund, we will allow you to claim it as a deduction as well. So there are a few technicalities that you should know in relation to this point, because in examination they may twist you with some twisty adjustments. So little bit careful you have to be. First of all, we will talk about employer's contribution. Employer's contribution. This is little bit tricky, okay? Employer's contribution is an out-of-pocket expenditure. Out-of-pocket expenditure for the employer. And he can claim it as a deduction. He can claim it as deduction under section 36. But only one thing you have to be very careful. It is claimed as a deduction only on actual payment basis. Actual payment basis. What do you mean by actual payment? Even if you put a payable entry in your books of accounts for the employer contribution, you will not get it as a deduction. Rather than simply putting a payable entry or making it payable, you have to actually make the payment to the recognized provident fund. Then only the employer can claim his portion as a deduction. Now the question is, imagine for the year 24-25, the employer have deducted his contribution to the provident fund. Okay, employer have deducted it. When to make the payment? Department say you need to make the payment on time, but. He say for the year 24-25, the employer will be filing his returns. Filing his returns on or before. There can be three possibilities. If he is subjected to audit, then 31st October of 2025. If you are a person who are subjected to audit, okay, then your return filing due date will be on 31st October. If you are a person who is subjected to transfer pricing audit, that is said to be 92E audit report, transfer pricing audit, your return filing due date will be 30th November 2025. And if you are a person who is not subjected to any audit, then your due date will be 31st July 2025. There are three due dates for filing your return. Okay, so number one, if you are a person who is subjected to audits, then 31st October. If you are a person who is subjected to transfer pricing audit, then 30th November 2025. If you are a person who is not at all subjected to any audit, then it is 31st July of assessment year. These three are the due dates. So depends upon you whether you are subjected to audit or not, your due dates differs. Imagine you are a person who is not subjected to any audits, then your due date will be on 31st July. So employer contribution, if you put a payable entry, you will not get it as a deduction. That's what I've told you. But you need to make the actual payment. For claiming employer's contribution as a deduction, you need to make the actual payment when at least on or before your due date of filing your return. It is not mandatory that you need to make the payment before the end of the relevant previous year. But before due date of filing your return, you need to make the payment. Then only we will allow you to claim it as your deduction. Otherwise, don't even think about claiming it as a deduction. This is what 43B says. So in examination, they may mix section 36 and 43B. What is 43B? Certain expenses are allowed as a deduction only on actual payment basis. That is called as 43B. Out of that, employer's contribution to provident fund, pension fund, gratuity fund, etc. is one of the points. So if you are an employer who makes payment to the recognized provident fund out of your pocket, then you have to make sure that it is actually paid. And the actual payment have to happen on or before due date of filing your return. Depends upon the due dates that is applicable for you. You need to make the actual payment. Otherwise, if you are not making the actual payment on or before due date of filing your return, then that payment, that payable entry is never allowed as a deduction. It is allowed as a deduction only on actual payment basis. I hope you got my point. This is related to employer's contribution. Now, what about employee's contribution? Imagine employee's contribution. So the employer will deduct it. When the employer deducts it, it will be considered as employer's income. Employer's income. It will be considered as employer's income. And when the employer makes the payment to recognize the provident fund or whatever the fund is, then he can claim it as a deduction. Basically, it is not his income, not his deduction, but for the better administration, what department say, Whenever you deduct it, it will be considered as your income, and whenever you make the payment to the respective provident fund account, you can claim it as a deduction. Whenever you deduct it, it will be your income. Whenever you deduct it from the employee's salary, okay? Employer deduct it means from the salary of employee, okay? Salary of employee, whenever the employee cuts it, it will be employer's income, and whenever he makes the payment to the recognized provident fund, it is allowed as a deduction. Now the question is when to make the payment. When to make the payment, it is not your return filing due date. Then what department say? The PF is covered under PF Act. In the PF Act, before 7th of next month, you need to make the payment. Before 15th, not 7th, I'm sorry. Before 15th of next month, you need to make the payment. Imagine you are deducting PF on, say, 31st of January. 31st of the January is when you make the salary payment. On that day, you are deducting the employee's contribution from his monthly salary. Then you need to make the payment before 15th February 2025. This is what the PF Act says. If you have made the payment before the due date as per PF Act, then you can claim it as a deduction. Otherwise, it is never allowed as deduction. That's what the department says. So, listen friends, this is little bit technical. Employee's contribution, when the employer cuts it from the monthly salary, will be the employer's income, and it is allowed as a deduction if the employer make the payment to the recognized provident fund according to the PF Act on or before the due date of PF Act. And what is the due date of PF Act? 15th of next month. So the employer technically have to make the payment before 15th of next month. Every month's cut have to be paid before 15th of next month. Then only the employer can claim that portion as a deduction. Otherwise, that income will be there as income and the payment will not be considered as your deduction. Now you understood what is the purpose of this provision. The purpose of this provision is to correctly cut everything on time and make the payment on time. Otherwise, the employers will never cut it, or they will cut it, but they will never make the payment on time. And the employees, out of their fear, will never question their employers. So that what department say, you cut it and you make the payment before next month 15. Only then we will allow you to claim it as a deduction, otherwise not. I hope you understood the difference between the employer contribution and the employee's contribution, because they may mix both the contributions in examination and they may confuse you. I hope you got an absolute clarity over this provision. So please respond via chat box, friends. Have you got an absolute clarity over employer contributions treatment and employee's contribution treatment? Tell me. Please respond, friends. Great. So moving on to the next point, friends, this is what they are saying. So I'll repeat that points again. I'll repeat this note again. So employer's contribution to the provident fund. What is the treatment? Allowed as a deduction based on actual payment basis. That's what I said. Employer's contribution have to be paid on or before due date of filing your return. To claim it as a deduction, it have to be paid on or before due date of filing your return under section 139 subsection 1, where we have 3 due dates, depends upon whether you are subjected to audit or not. That is number 1. Number 2, employee contribution treated as income in the hands of the employer, allowed as deduction only if it is paid to the respective fund on or before due date as per the respective act. This is what the department says, and I hope it is clear for you. Moving on to the next deduction, friends, contribution to the pension fund mentioned under 80 CCD. Imagine the employer is making a payment to the pension fund on behalf of the employee. the employer is making a payment to pension fund. To the employee, pension fund to the employee. That payment given by the employer to the pension fund is fully allowed as a deduction under section 36. Let's see what exactly are the points over there. So, contribution to the pension fund mentioned under 80CCD. The employer makes any payment to the pension fund on behalf of employee for the employee's benefit. Because from the pension fund, the employee will be getting pension on his retirement. So for that, the employer every year is making a payment to the pension fund. Once the employer retires, he will be getting a lump sum amount, or he will be getting monthly pension from the pension account. Now, for employer, it's a cost and he can claim it as a deduction. But there is a ceiling limit for the deduction that he can claim. It's an amendment. 14% of basic salary plus DA retirement, which forms part of the retirement benefit to the employee, is allowed as a reduction. That simply means whatever the basic salary of employer and whatever the DA of the employee, whatever the basic salary of the employee, okay, not the employer, whatever the basic salary of the employee, plus whatever the DNS allowance paid by the employer to the employee, which forms part of the retirement benefit. You take total of these two, apply 14%. Up to that 14%, employer can claim it as a deduction. If the employer contribution is over and above 14%, then excess shall be disallowed under section 40A9. So, very simple example I can give you. Imagine the basic salary of employee is say 10 lakh. DNS allowance, which forms part of the retirement benefit, is say 2 lakh. So, basic plus retirement benefit, or basic plus DA forms part of the retirement benefit, is how much? 12 lakh. And the employer pays, say for example 6 lakhs to 80CCD referred pension fund. Not provident fund, it is pension fund. Okay, I'll write pension itself. Employer every year pays 6 lakhs to the pension fund. Now the question is, can the employer claim this entire 6 lakhs as a deduction? Let's see what section 36 says. Whatever the basic plus DA, you apply 14% of that. So 12 lakh into 14%, and how much it will be? 1,68,000. You can only claim 1,68,000 as a deduction. You apply 14% of this, that will be 1,68,000. You can only claim 1,68,000 of this as a deduction. How much is the remaining? Remaining means 1,68,000 minus 6 lakh is the actual payment. So the remaining is 4,32,000. That 4,32,000 is a disallowance under section 40A9. Even though it is a cost for the employer cannot claim that 4,32,000 as a deduction, because section 36 clearly states that maximum ceiling limit is only 14% of basic salary plus DA. Earlier it was 10% of basic salary plus DA. That Finance Act 2024 amended it and they made it 14% of basic salary plus DA. I hope that point is also clear for you. So the point is very clear, very simple. Employer contributes any amount to the pension fund of the employee. That contribution, and how much is the maximum contribution allowable as a deduction? Maximum contribution shall be basic salary plus DA, that forms part of the retirement benefit, is allowed as a deduction. 14% of basic plus DA, that forms part of retirement benefit, is allowed as a deduction. The rest is not allowed as deduction. That's what the department say. The rest is a disallowance under section 40A9. That's what the department say. I hope that point is clear for you. Moving on to the next point. What is that, friends? Bad debts allowed as deduction provided it is written off from books of accounts. Imagine you have made some credit sales. You have made some credit sale of 10 lakh. And you will create debtors account 10 lakh. Because you haven't received that amount, it's a credit sale. So after 2-3 years, you understood that the debtor is not gonna make you the payment. The debtor is not gonna make you the payment. Oh my God, gone everything. So you will claim it as bad debt. You will write it off as bad debt. If you have written off bad debt, you have written off debts as bad debt, you can claim that entire 10 lakhs as a deduction under section 36. Very simple. So bad debts allowed as deduction provided it is written off from books of accounts. If you are writing off bad debts from your books of account, you can claim that entire bad debt as a deduction. Are you all with me? If you simply create a provision, for bad and doubtful debts, that is never allowed as deduction. You need to actually write off bad debts to claim it as a deduction. If you simply create a provision for bad debt, you will never get it as a deduction. That's what the department says. Okay, fine, perfect. What is next? After claiming deduction, okay, if subsequently recovered, then deemed income under section 41. Okay, imagine year 1, there was a credit sale of 10 lakh. Year 2, you written off that entire 10 lakh as bad debt because that person, your debtor, called you and he told you that he is not going to make any payment. In year 5, that debtor came back and paid the entire 10 lakh. So you can call it as a recovery of bad debts. Recovery of bad debts means you have already claimed it as a bad debt and you got that amount back after some years. So whatever recovery you have, recovery of bad debts, is fully taxable as an income. Why? Because when you have done that credit sale, you will show it as your income. When it is bad, you will write it off and claim it as a deduction. And ultimately, when the debtor comes after a few years, the debtor came and made you the payment. If that happens, then that payment received by you again have to be shown as your income. So that is what they are saying. After claiming deduction, if subsequently recovered, then deemed income under section 41. So once you have claimed bad debt as a deduction and thereafter you subsequently recovered that entire bad debt, then the year of recovery, that entire bad debt is fully, that bad debt claimed earlier as a deduction have to be fully considered as your income and you have to pay tax accordingly in the year of receipt. That is what they are saying and I hope that is also clear for you. Moving on to the next item. These items are under 36 only. Okay, we haven't completed section 36. These are the sub-clauses and clauses under section 36. Alright, moving on to the next one. Family planning expenditure. Okay, if you are a company assessee, imagine you are a company assessee. This deduction is only allowable for company assessees. These deductions are only allowable for company assessees. If you are a company assessee and you have expended something to promote family planning among employees. Okay, you are a company and you are promoting family planning among your employees. For that, you have incurred some expenditure. That expenditure have to be divided into two. Number 1, capital nature expenditure. Number 2, revenue nature expenditure. Whatever the capital nature expenditure incurred by the employer for promoting family planning is allowed as a deduction in 5 equal annual installment. Listen, if you are an employer and you are promoting, you are an employer being a company employer, okay, you are a company assessee and you are now promoting family planning among your employees. Whatever the expenditure that you have incurred for promoting family planning among your employees have to be divided into two. Number 1, capital expenditure. Number 2, revenue expenditure. Capital expenditure is allowed as a reduction in 5 equal annual installment and revenue expenditure is allowed as a reduction in that respective year itself. Allowed as deduction in that year itself. This is what the department say. Whatever the capital expenditure that you incur is allowed as a deduction in 5 equal annual installment. Whatever the revenue nature expenditure that you allowed is as a deduction in that year itself. So capital nature expenditure have to be divided in 5 equal annual installment. Every year 5. That means every year 1/5. Revenue nature expenditure in that year itself. Whatever year you incur that year itself, you can claim it as a reduction. Now, one more point. Unabsorbed expenditure can be carried forward to unlimited subsequent years and can set off against future income. So, if you have any unabsorbed family planning expenditure, you can carry forward this to the next year. How many years you can carry forward? Unlimited. There is no time limit for this carry forward. You can carry forward this to unlimited subsequent years and you can claim it as a reduction. No problem at all. Just like our unabsorbed depreciation, just like our scientific research expenditure, you can carry forward this to unlimited subsequent years and claim it as a reduction. Are you all here? Are you all getting that point? So this is what they are saying as family planning expenditure. Again, only for company SSA. So in examination, you have to be careful. Only if it is a company SSA, you will be getting it as a reduction. If they say Mr. A, an individual, incurred family planning expenditure, then you have to disallow it. Disallow it. You cannot claim it as a deduction. I hope you are getting my point. Moving on to the next one. Next is STT. What is STT? Security Transaction Tax. If you are a person who are buying, where you are buying securities through a recognized stock exchange, you are buying some shares of Tata Motors through NSE, National Stock Exchange, you need to pay security transaction tax. Now the question is, can you claim that security transaction tax as a deduction under section 36? The answer is yes, but subject to condition. What is that? So STT allowed as a deduction only if business income is due to purchase or sale of securities. If your main business income is from purchase and sale of securities, then only you can claim that STT paid as a deduction, otherwise not. Imagine I am a chartered accountant and I am claiming and I've invested some of my money in listed shares. Okay, I'm a chartered accountant, invested my money in listed shares. That investment, okay, is not my business activity. That is only to increase my capital, increase my wealth. So I've invested something in the security listed share. Okay, for that I'm paying STT. I can never claim that STT as a deduction. Even while computing PGPP or capital gain, I cannot claim that as a deduction, that STT paid as a deduction. So STTs means security transaction. That means when you purchase shares or sell shares, on the transaction value you need to pay a small percentage as tax to the government. That is called as STT, security transaction tax. So security transaction tax is allowed as a deduction only if your main business income is from purchase and sale of securities, otherwise not. This is what the department says. So STT allowed as deduction only if business income is due to purchase and sale of securities. If I am a full-time trader, keep on purchasing listed shares and selling listed shares, then only I can claim STT paid as a deduction, otherwise not. That's what the department say. Likewise, there is another thing called CTT, called as commodity transaction tax. Can I claim commodity transaction tax as a deduction? The answer is yes, again subjected to conditions. You tell me what are the conditions. Allowed as a deduction only if business income is due to purchase and sale of commodities. If I'm a person who is claiming CTT or who is paying CTT, I can claim that CTT as a deduction only if my main income is from out of purchase and sale of commodities. Otherwise, don't even think about claiming CTT as a deduction. This is what the department say. So two things, STT, CTT, allowed as a deduction only if your main business income is from purchase and sale of security, only if your main business income is from purchase and sale of commodity. Commodity means gold, crude, silver, platinum, etc. You can buy through RSCs, recognized stock exchanges, currencies, etc. Those are considered as commodities. These commodities, when you buy and sell, you need to pay a small percentage of tax to the government. That is called a CTT, commodity transaction tax. The point is whether you can claim that commodity transaction tax as a deduction only if it is your main business income, otherwise not. So I hope that also is clear. So by that I can say section 36 is also over. Moving on to the next section, section 37. What is 37? General deduction. So we have discussed deductions from section 30 to 36. Okay, we have discussed different deductions from section 30 to 36. And if there is any other expenditure, if it is not covered from section 30 to 36, then if it is related to your business, then you can claim it as a deduction under section 37. For our examination, it is such an important section. You need to know this section in a perfect manner. So we call it as a general deduction or residuary expenses or residuary deduction you can call. So if an expenditure you have incurred exclusively for your business or profession, that deduction is not covered under section 30 to 36, then you can claim it as a deduction under section 37. For example, salary to employees, traveling expenses, food expenses, power and fuel, printing and stationery, etc., which is exclusive business or professional expenditures. If it is exclusively incurred for your business or profession, you can claim it as a deduction. Say for example, food. Okay, I am a person, individual, sole proprietor, having food from hotel. It's a personal expenditure. I cannot claim it as a deduction. I am providing free lunch to my employees. Okay, in my premises, business premises, I am providing free lunch to my employees. That's just like a perquisite. That I can claim as a deduction. Why? Because it's an exclusive business expenditure. So 37 items. If you want to claim an item as a deduction under 37, then that should be an exclusive business expenditure. Otherwise, don't even think about claiming deduction under 37. Now, there are a few more things that you should know. Number one, penalty for violation of law. Not allowed as deduction. Imagine you are paying any penalty for violating any law. whether it is Indian law or foreign law, that penalty that you have paid is never allowed as a reduction under section 37. Okay, whatever penalties, that is payment that you have paid in relation to violation of any law, never allowed as deduction under section 37. Second one, contractual penalty allowed as a deduction. Imagine you have paid a contractual penalty. What do you mean by contractual penalty? You agree to deliver some goods in 7 days to your supplier or to your customer. You agree to deliver some goods within 7 days, but you delivered it only on the 10th day. And your supplier asked for some damages. You paid rupees 1 lakh as a compensation because you haven't delivered it on time. So you paid rupees 1 lakh as compensation. This is not due to violation of Contract Act. These are just damages. Damages means due to your delay, your supplier might have incurred some loss. To compensate that, you are paid this 1 lakh. So we call it as a contractual penalty are always allowed as deduction. So you are making a payment, making a damage, making something like a compensation. We call it as a contractual penalty, which is paid under a contract. That is always allowed as deduction. That is not due to violation of Contract Act. Contract Act simply says parties can definitely write damages and they can recover damages from the other party. Now, even though it is called as penalty, these are basically damages. The characteristics of damage. Okay, these are basically considered as damages only, and hence you can claim all the damages that you pay as a deduction under 37. That is not on account of violation of any law. Say for example, you parked your car in no parking and motor vehicle department have charged a penalty. That is never allowed as a deduction. Or you have overspeeded, no seat belt, no helmet, petty, never allowed as deduction. You violated some municipal law and paid some penalty, never allowed as deduction. Contractual penalties are not due to violation of any act, and hence it is considered as a damage only, and hence it is allowed as a deduction. Next one, compounding fees never allowed as deduction. What is compounding fee? Imagine you have violated municipal law and the municipality is not giving you completion certificate. To get water connection and electricity connection, you should have a completion certificate in relation to building. Okay, you constructed a building, violated municipal law. Now you have applied for what completion certificate? Your municipality told no completion certificate for you. You violated all the municipal law. So you went to the municipality and said, "Sir, help me, sir." Then the municipality will say, "Don't worry, man. Don't worry. You do one thing. You pay some compounding fee." Compounding fee means a penalty which is to compound an offense. Okay, we will charge some compounding fees and we'll give you what? We'll give you completion certificate. Never ever repeat this. This is just like we are charging some huge amount from you so that you will never violate any municipal law. So the compounding fees are basically penal in nature, and hence compounding fees are never allowed as deduction under 37. Moving on, freebies given by pharma companies to doctors not allowed as deduction. Imagine I am a pharmaceutical company and I am giving gifts to medical practitioners or doctors. Freebies means gift. Okay, freebies means what? Gift. Imagine I am a pharma company and I am paying freebies or gift, etc. to doctors. That is never allowed as a deduction under section 37. Why? Because that is completely opposed to the public policy and you can never claim it as a deduction under section 37. These points are worth noting. So freebies given by the pharma company to the doctors never allowed as deduction under section 37. Next one, political party contribution never allowed as a deduction. If you are giving some donation to any political party, that donation is never allowed as a deduction under section 37. This is what the department say. And now, what to do with the political party contribution? Political party contributions are allowed as a deduction under section 80GGB. Under chapter 6A reduction. Chapter 6A reduction, if you have donated something to political party, you can claim it as a deduction under 80GGB. Only one condition is there. Your actual payment have to happen in any mode other than cash. You are not supposed to make any cash payment. If you are paying that amount in any mode other than cash, you can claim it as a deduction. 80GGB. If you are a company SSC. If you are an individual partnership firm, etc., then you can claim it as a deduction under section 80GGC. Okay, so political party contributions are allowed as deduction in two sections, 80GGB and 80GGC. GGB is for political party, GGB is for company SSCs who are donating to political party, and GGC is for other SSCs who are donating to the political party. Now, political party donations are never allowed as 37, deduction under 37. As a business expenditure, you can never claim it. So imagine in the P&L account, the accountant have debited political party contribution. So what you should do, if the accountant has debited political party contribution in the P&L account, then what you need to do is you need to disallow. You need to disallow it as a deduction. You need to disallow. You need to add back that deduction under section 37 and claim it under 80 GGB as a chapter 6A deduction once you completed profit from PGBP, compute gross total income, then claim it as a deduction from the gross total income. Are you all listening? Have you understood what I said? Please respond, friends. All right, all good, all good. So listen. So what they are saying is, if you have donated something to what? A political party, that is never allowed as a deduction under section 37. Then if it is debited to the statement of P&L account in examination question, what you need to do is you need to add back. You need to add back. Then you compute the business profit. Then you claim it as a deduction under chapter 6A 80 GGB or 80 GGC. Perfect. Moving on to the next one. Imagine you have done some advertisement in a political party magazine. A normal advertisement expenditure is a business promotion expenditure. Definitely you can claim it as a deduction. Imagine you have given an advertisement in a political party magazine. If you are advertising in a political party magazine, that is never allowed as a deduction under section 37, because all the advertisements that are given in the political party magazines are considered as a PP donation. What is PP? Political party donation. So if you have given an advertisement in a political party magazine, that is never allowed as a deduction under section 37. That will be considered as a political party contribution only and allowed under 80 GGB or GGC only. So two things you have to be careful. Direct political party donation. Number two, political party magazine, if you are putting an advertisement, that also will be considered as a political party donation. Both are not allowable under 37. So if in the P&L account, if they have debited it, you need to add it back and claim it as a deduction under 80 GGB or 80 GGC. This is what the department says. Moving on to the next point, friends. What is the next point? GST paid allowed as a deduction. Imagine you have paid some GST and you are not taking ITC. What is ITC? Input tax credit. You paid GST and you are not paying any input tax credit. Absolutely no problem. You can claim that GST paid as a deduction. If you are a person who paid GST and you are not claiming input tax credit, it is allowed as a deduction. But if you are claiming input tax credit, that is not your cost and hence you cannot claim it as your deduction. That's what the department says. Alright, how about GST penalty? Can you claim GST penalty as a deduction? The answer is never, because GST penalty is on account of violation of GST Act or SGST or CGST Act or IGST Act, whatever it is. So GST penalty is never allowed as a deduction. That is disallowed under section 37. Now, GST interest, another question. GST interest, whether it is allowed as deduction? The answer is yes. GST interest is definitely allowed as deduction because it is normally considered as a compensatory cost. What is compensatory cost? Very simple. GST interest is normally paid when you are not paying the GST on or before its due date. Yes or no? So that is compensatory in nature, not penal in nature. So department says GST interest paid is definitely allowed as a deduction under section 37. Allowed as a deduction, absolutely no problem. Moving on to the item in between, personal expenses. Nobody shall claim their personal expenses as a deduction while computing PGBP, traveling cost from house to office, etc. Never allowed as a deduction while computing business profits. If you are planning to claim your personal expenses under 37, department will never give you deduction. If personal expenses are debited in the P&L account, what you need to do? You need to simply add it back by saying that personal expenses are not allowable as deduction under section 37, and I hope it is also clear. So these are the items that is worth noting under section 37, because section 37 is a general deduction. 30 to 36 is little bit simple because it is specific and clear. 37, all other expenses which are exclusively incurred for your business or profession is allowed as deduction under 37. This is what the department say. So I hope it is clear. So friends, we have started from the net profit. We have covered all the allowable expenses from section 30 to 37. Now you will ask, what is pending? We have disallowances to cover. So let's move on to the disallowances. Disallowances means the following items have to be added back. So the following, if debited to the P&L account, you need to add back because it is not allowed as deduction. The following items, if they are debited to the P&L account, never claim it as a deduction. You need to add back. Let's understand which all are the disallowances. First disallowance, section 40A1 or 40A1A. Two sections are there. I've written 40A1. One more section is there, 40A1A. This is not I, okay. This is section 40, close number A, subclose number 1. Don't call it as, read it as I. It is 40A1 and 40A1A. That is disallowance for default in TDS. If you are not deducting TDS, there will be a disallowance. That's what we are about to discuss. Hope you know the TDS, the concept of TDS. I'll give you a simple example to start with. Imagine I am a company called JK Limited, and imagine you are my auditor. Okay, you are my auditor, internal auditor. When I am about to make you payment, say imagine I am paying you 10 lakh. I need to deduct what TDS. Say professional service 194J is the section. I need to deduct 10% as TDS. 10% means 1 lakh. 10% on 10 lakh means 1 lakh have to be deducted as TDS. And how much is the remaining? The remaining shall be 9 lakh. Imagine JK Limited is a company and you are an internal auditor. Have done some services to JK Limited. JK Limited is about to pay you 10 lakh rupees. The TDS rate is 10% under 194J. On 10 lakh rupees, 1 lakh, 10% of 10 lakh, that is rupees 1 lakh, have to be deducted by JK Limited as TDS, and JK Limited is required to make this 1 lakh payment to the credit of government. Are you with me? So this is how the TDS works. Now, listen. If JK Limited, for JK Limited, this 10 lakhs is an expenditure. Audit is an expenditure. The cost of audit is basically an expenditure. So for JK Limited, this 10 lakh is an expenditure. If JK Limited want to claim this expenditure as a deduction, then two things are there. First of all, JK Limited have to deduct the TDS in the relevant previous year itself. In the previous year itself, JK Limited have to deduct the TDS. Imagine this is 2024-25. This payment happened in the year 2024-25. Then JK Limited have to deduct TDS in the year 2024-25. The TDS deduction have to happen in the year 24-25 itself. Now, not yet over. JK Limited have to make the payment to the credit of central government. This TDS deducted have to be made to the credit of central government. Yes or no? So JK Limited have to make the payment to the credit of central government on or before, at least before due date of filing the return. Due date of filing a return. So two things have to be very careful. Number one, JK Limited have to deduct the TDS in the relevant PY itself. Number two, before JK Limited file their return of that respective year, they need to make that payment to the credit of central government. If both are not done, if any default is there, then disallowance will be applicable under section 40A1 and 40A1A. This is what we are about to discuss right now. And this making use of this example, I'll explain the concept of 40A1 as well as 40A1A. So let's discuss this one by one. Imagine. What is the first point? Disallowance for default in TDS. any sum payable to non-resident. Imagine auditor is a non-resident. That internal auditor is a non-resident and JK Limited is paying rupees 10 lakh to that non-resident internal auditor. And the payment is except salary. Payment is any payment other than salary. It is any sum other than salary. Partial payment, it's not salary. Then TDS not deducted in the relevant PY. As I've told you, from the 10 lakh, if JK Limited is not deducting TDS, then in the relevant PY, then 100% of that amount paid, entire 10 lakh shall be fully disallowed. 100% of that payment, entire 10 lakh shall be fully disallowed because very simple, when you are paying what, any amount, and that amount is covered under chapter 17B, that is TDS schedule, and you are not deducting TDS in the relevant previous year, then what department will do? Department will disallow that entire payment made under section 40A1. If the payee, that means internal auditor, is a non-resident. And one more thing is there, after deducting TDS, so you have deducted 10% or whatever the rate is, NR separate rate, not under 194J. If the payee is NR, it will be under a separate rate, 195 normally. So in the case of payee being an NR, you have deducted the TDS as per the relevant rate, but you haven't paid it to the credit of central government on or before your due date of filing return. You have deducted it, but you haven't made the payment to the credit of central government on or before your due date. Then also there is a danger. What is that danger? Then also 100% of that amount is fully disallowed. So to claim it as a deduction, you have to be very careful with two things. First, you need to deduct TDS on time. Second, that deducted TDS have to be paid to the credit of central government on or before due date of filing a return. These are the two things that you have to be very careful with if you are dealing with TDS. Are you all with me? Now, this disallowance is basically a temporary disallowance. Why? Say you haven't deducted this year, or you have deducted but you haven't made the payment to the credit of central government on or before due date of filing your return. And if default is rectified in the subsequent year, say next year you have collected the TDS or you have made the payment to the credit of central government, then the amount disallowed this year is allowed as a deduction in the next year. Once you rectify this default, then you can claim that disallowed amount as a deduction. So what department say, whenever there is a default, we will disallow it. If you have rectified that thing in your future, then the year of rectification, you can claim it as a deduction. So if default rectified in subsequent year, it is allowed as a deduction in the subsequent year. That disallowed amount is allowed as a deduction in subsequent year. That's what the department say. It is a temporary disallowance. Why it is called as a temporary disallowance? Because unless otherwise there is a default. If there is a default, there will be disallowance. Once you rectify the default, there will not be any disallowance at all. So this is the concept of 40A1, that is payment to an NR except salary. Second one, section 40A1A, that is any sum payable to resident including salary. Say JK Limited is paying any sum to internal auditor, and the internal auditor, if he is a resident, then disallowance will be under section 40A1A. This 40A1A is including salary. Even if it is a salary payment, disallowance will be there under section 40A1A. But if the payee, that means in our example, internal auditor, if he is a non-resident, then salary payment disallowance is not covered under section 40A1A because they are clearly saying except salary. Okay, so why? Because for salary there is a separate disallowance. For salary there is a separate disallowance that we will deal later. That's why. But if the payee is a resident, it is including salary. So let's understand. So TDS not deducted in relevant previous year. 30% of amount paid is disallowed. Imagine JK Limited is not deducting the TDS and the payment made by JK Limited to the internal auditor is 10 lakh. Not the entire 10 lakh is disallowed. Only 30% of 10 lakh. That means 3 lakh is disallowed. The remaining 7 lakh you can claim as deduction. It is deductible. So what department say, if the payee is a resident and you are not deducting the TDS, then the entire 10 lakh is not disallowable. Only 30% of 10 lakh shall be disallowed. The rest you can definitely claim as a deduction. And after deducting, if you are not making the payment to the credit of central government on or before due date of filing return also, 30% of amount shall be disallowed. So you have to cut the TDS and you have to make the payment to the credit of central government. Both are required. Otherwise, if the pay is resident, disallowance shall be 30%. If the pay non-resident, disallowance shall be 100%. And again, this is also a temporary disallowance. Why? If default is rectified in the subsequent year, it is allowed as a deduction in the subsequent year. So, just like that 40A1, 40A1A also says that 30% disallowed figure this year. If you have default in TDS have been rectified in the future year, you can claim that 30% disallowance as a deduction in the future year. So whenever you rectify that default in the year of rectification, you can definitely claim it as a deduction. I hope it is clear for you. So this is how you have to deal with section 40A1 and 40A1A. Both are temporary disallowances. Now, listen. One thing I've told you. If your payee is a non-resident and you are making salary payment without TDS, then no disallowance under section 40A1. That is what I've said, right? If you are a person who is making salary payment to your payee, and that salary payment, you are not deducting TDS, or you have deducted but you are not making the payment to the credit of central government, then no disallowance under section 40A1. Oh, then you will think there is no disallowance if TDS default is there. No, it is not like that. It is not disallowed under 40A1, but there is a separate section for that disallowance. Let's understand that section. Section 40A clause number 3. What is that? Salary payable to non-residents, TDS not deducted, or after deduction failed to make payment to the credit of central government. So, whenever a person, JK Limited, paying salary to a non-resident employee, either they are not deducting TDS in the relevant previous year, or after deduction they are not making payment to the credit of central government on or before due date of their return filing date. In both the cases, there will be a disallowance. And how much is the disallowance? 100% of the salary, but it is disallowed forever. Array, what is disallowed forever? That means even in the subsequent year, even in next year, if you rectify it, you will not be getting it as a deduction. It is a disallowance for once and for all. So, section 40A1 and section 40A1A, both are temporary disallowances. Both are temporary disallowances. What is temporary disallowance? Once you rectify that default in future, you can claim it as a deduction. That's what both the sections says. But section 40A3, that means payee, being a employee, non-resident, no TDS. It's serious. No TDS. Once disallowed, disallowed forever. In future also, if you deducted the TDS in a correct manner, no way. We have no plans to give you that deduction. Once it is disallowed, it is disallowed forever. It is more serious. So section 40A3 is a kind of a section where you, once it is disallowed, then don't even think about getting it again. Once it is disallowed forever. Are you all with me? Have you understood the difference between section 40A1 and 40A1A? See here, in this section 40A3, it is only salary payable to NR. If salary payable to resident without TDS, it will be covered under 40A1A, and it's a temporary disallowance only. Are you all with me? Have you understood what I said? Please respond, friends, in the chat box. All good, right? So, moving on, friends, moving on with the next point. What is the next point? In between, there is a point. Next disallowance. We are talking about disallowances, okay? So, what is the next disallowance? Section 40A, clause number 2. What is that? Income tax not deductible. Okay. So, whatever income tax that you have paid, like your basic tax, surcharge, cess, interest related to income tax, penalty related to income tax, everything disallowed. You will never get anything as a deduction. Whatever basic tax, surcharge, cess, interest, penalty that you have paid is fully disallowed. You will never get it as a deduction. If these items are debited in the P&L account, then you need to add it back because these items are never allowed as deduction. It is as simple as that. Moving on to the next point, section 40B. That is a deduction allowable for partnership firms. If partnership firm pays interest on capital to partners or remuneration or salary to working partners, if the partnership firm pays interest on capital to partners or remuneration or salary to working partners, both are allowed as a deduction, but it is subjected to ceiling limit. If you are making a payment in excess of the ceiling limit, excess shall be fully disallowed. The excess shall be disallowed under section 40B, and that is what we are about to discuss. So please listen. Let's understand what exactly is 40B. So what they are saying is, interest on capital to partners is allowed as a deduction only up to 12%, that is up to 12% allowed as deduction, excess disallowed. Imagine the capital account balance is 10 lakh and the partnership firm is paying 14%, that is 1,40,000 as interest to the partners. You will not be getting this entire 1,40,000 as a deduction. You will be getting maximum 12% of this 10 lakh, and how much is that? 1,20,000 is only allowed as deduction. The remaining 20,000 have to be disallowed under 40B. This is what the department say. If any partnership firm pays excess interest over and about 12% to the capital balance or 12% on capital balance to partners, excess shall be fully disallowed. Only 12% is allowed as deduction. This is what the department says. So that point is pretty simple. What is that? Read it again. Interest on capital to partners up to 12% allowed as deduction, excess have to be disallowed. Then what is the second point, friends? Second point, it simply means remuneration to working partners. If you are a partnership firm and you are paying remuneration to working partners, that remuneration paid is again fully allowed as deduction. So if you are a partnership firm, you are paying remuneration to working partners, that remuneration to working partners is fully allowed as a deduction. And let's understand how to claim that deduction. Now, you can see it from here, how to claim it as a deduction, friends. So please listen. What they are saying is remuneration to working partners up to, there is a ceiling limit. And how do you claim ceiling limit? Based on book profit. Based on what? Book profit. What is book profit? That I'll tell you later. Okay. Now, remuneration to working partners up to 6 lakh book profit, or in case of losses, rupees 3 lakh or 90% of the book profit, whichever is higher. On the balance book profit, 60% on the balance. Okay. Excess shall be disallowed. Okay. What is book profit? I'll tell you later. Imagine book profit is say 20 lakhs. Imagine your book profit is say 20 lakh. How to compute this book profit? That I will tell you later. Okay. Imagine your book profit is 20 lakh. Then how do you claim the ceiling limit? Up to first 6 lakh book profit. 6 lakh book profit. What is the ceiling limit? Either rupees 3 lakh or 90% of 6 lakh. 90% of 6 lakh, whichever is higher. How much is 90% of 6 lakh? 5 lakh 40. So what department say? Either 5 lakh 40 or 3 lakh, whichever is higher. Which is higher? 5 lakh 40 is higher. So up to 6 lakh book profit we have taken. How much is the remaining book profit? 14 lakh, because your total book profit is 20 lakh. So the remaining book profit is 14 lakh into 60%. How much is 14 lakh into 60%? Let's see. 14 lakh into 60% will give you 8 lakh 40,000. So how much is the total ceiling limit? 5 lakh 40 plus 8 lakh 40. So 6 into 90%, 5 lakh 40 plus 8 lakh 40. So 5 lakh 40 plus 8 lakh 40 will give you 13 lakh 80,000. A partnership firm can pay up to 13 lakh 80,000 as a remuneration to all partners in a year. This 13 lakh 80,000 is not a remuneration to one single partner. It is not remuneration in a month. It is the total amount of remuneration that the partnership firm can pay to all the partners, to all the working partners in a year. And one more thing, imagine your actual remuneration is say 14 lakhs. It is over and above the ceiling limit of 1380. So 20,000 have to be disallowed in such case. Or imagine your actual remuneration is say 13 lakhs. Then you can claim only 13 lakhs because these are ceiling limits. Ceiling limits are always subjected to actuals. If actual is less, you can only claim actual. If the actual exceeds, maximum allowable amount is the ceiling limit. Ceiling limit is the top limit that you can claim. Hope you are getting my point. So, very simple, up to 6 lakhs book profit, or in the case of loss, you can claim a minimum of 3 lakh or 90% of the book profit, whichever is higher. Imagine you are a partnership firm having 1 lakh book profit. Your book profit is only 1 lakh. Then up to 6 lakh, you don't have 6 lakh book profit. You only have 1 lakh. So 1 lakh into 90%, 90,000 or 3 lakh, whichever is higher. So you can claim 3 lakh as a deduction and you can claim it as a loss. 1 lakh is your book profit, 3 lakh is the allowable deduction, and you can show a loss of 2 lakh. No problem. So that is what they are saying. Up to 6 lakh book profit, or in case of loss also, you claim 3 lakh or 90% of whatever book profit up to 6, whichever is higher. Are you with me? On the balance, if there is any, you apply 60% and compute the ceiling limit. Excess, if any, have to be disallowed. If the actuals are less than the ceiling limit, then you can only claim the actuals. This is what they are saying. Now, the $1 million question, what is this book profit? Book profit means current year PGBP profit before adjusting brought forward business loss and actual remuneration paid by the partnership firm to the partners. So, book profit simply means you compute the current year PGBP income, but don't adjust remuneration and brought forward losses from the last year. So, current year remuneration as well as brought forward losses from the last year, before you adjust these two, whatever the PGBP profit you have this year is said to be your book profit. I'll read that again. Current year PGBP computed profit before adjusting brought forward business loss and actual remuneration paid by partnership firm to the partners. Don't adjust these two. Apart from that, you need to adjust everything. Even you need to adjust electricity charges, printing, stationery, whatever under PGBP, whatever that you can claim as a deduction, you adjust everything and compute the book profit. But don't adjust remuneration as well as brought forward loss. So that figure is said to be the book profit and you apply the ceiling limit on the book profit, and you claim the deduction under this particular section, and I hope it is clear for you. This is what they are saying. This is all about 40B, friends. Now moving on to the next sections, friends, that is section 40A2. Let's understand what is this 40A2. So please listen. 40A2. So 40A2, what they are saying is excess payment made to relatives and associates. Very simple. If you are a person, okay, you are Mr. or you are JK Limited. Okay, say you are JK Limited. You are a company called JK Limited, and JK Limited have paid excessive payments. Salary to JK's brother. JK is an individual. JK's brother is working as accountant. For normal accountant salary, say 5 lakh in a year, and JK Limited is paying 7 lakhs to his brother as salary. So the normal salary in the market is only 5, and JK Limited is paying 7 lakh salary to their brothers. So this is considered as an excess payment. In examination, they will definitely give you the market salary, normal salary, or the normal payment, and they will give you the actual payment. So if it is an excess payment, then you need to disallow that excess portion under 40A2. How much is the excess portion? 7 is the actual payment, 5 is the normal limit. So excess will be 2 lakh. 2 lakh you have to disallow. That means if the entire 7 is debited to the P&L account, you need to add back 2 lakh. If the entire 7 is debited to the P&L account, you need to add back 2 lakh. Let's see. excess payment made to relatives and associates. If you are an individual, shall not make excessive payments to your spouse, your brother or sister, your lineal ascendants. What is lineal ascendant? Your father, grandfather. Your lineal descendants. That means your son or daughter or grandson or granddaughter. So if you are an individual, you are not supposed to make any excessive payments to spouse, brothers, sisters, lineal ascendants, lineal descendants. If you have made excess payment, that excess, not the entire payment, that excess shall be disallowed under section 40A subsection 2. If you are a company and you are making payments to your directors or relatives of directors, you are a company and making excessive payments to your directors or relatives of directors, then the excess payment shall be disallowed in the hands of company. So depends upon the assessee, the relatives also changes. Company assessee, directors and relatives of directors are considered as a related person. You are not supposed to make excess payment to these persons. You can make excess payment to third parties, no problem. You can make excess payment to third party. So if in the question they are saying that excess payment to third party, that don't disallow. Only to related persons which are covered under 40A2, if you are making excess payment, that is disallowed. If you are making excess payment to third parties, nothing to worry. You can claim that entire amount as a deduction. For a firm and LLP, who are the relatives or related persons? All the partners, relatives of partners. HUF, AOP, BOI, who are the related persons? Members, relatives of the members. And then, if you are any person, their relatives have substantial interest in any other person. Oh my God, what do you mean by this? Imagine, you are a company. For a company, their directors are related persons. For a company, their directors are what? Related persons. Yes or no? So if the company makes any excessive payments to directors, that excess will be disallowed under 48. Imagine this director have substantial interest in another company. You will write another company. This director have substantial interest. That means 20% or more voting power. 20% or more voting power in another company. This director have 20% or voting power in another company. Then this company and the other company are considered as related persons. And this company is paying some excessive payment to another company, that will be fully disallowed. So any person or their relatives have substantial interest in any other person, both of them are considered as what? Associates, and they are not supposed to make excessive payments in between. Are you with me? So section 48.2 says if you are a person making excess payments or excessive payments compared to the normal market standards, that excessive payments shall be considered as disallowance under section 48.2. Only that excess shall be disallowed. Moving on to the next one, friends, that is section 40A3. And you tell me what is 40A3? Very simple. We have discussed a lot of deductions from section 30 to 37. Okay, while paying these expenditures, or we have discussed different expenditures from 30 to 37. Okay, so while paying these expenditures, if single day payment, while paying this expenditure, if single day payment exceeds 10,000, if single day payment exceeds how much, friends? 10,000, then mode of payment have to be only by way of prescribed modes. That the mode of payment have to happen only by way of prescribed modes. If you are not making a payment in prescribed modes, then what will happen? Excess shall be disallowed. Very simple. You know what is the prescribed modes? 4 modes are there that we have already learned. Account pay cross check, account pay bank draft, ECS, prescribed electronic modes. Yes or no? Say for example, you are paying salary. Amount is rupees 1 lakh to your employee. All of a sudden, in a day you are paying salary of rupees 1 lakh to your employee by cash. Fully disallowed. Section 40A3. So, any expenditures covered to 30 to 37, if the single day expenses exceeds 10,000, mode of payment have to be only through prescribed mode. If not, entire payment shall be disallowed. Not 90,000. 10,000 is actually a threshold. If that exceeds threshold, then the entire 1 lakh shall be disallowed. Don't learn it like up to 10 you can claim. It is not like that. 10 is a threshold. If your payment is, say, you are paying 11,000 in cash as salary to employee, entire 11 is disallowed. You are paying 10,000 in cash to your employee, nothing shall be disallowed because that is not exceeding 10. So exceeds 10, everything shall be disallowed under 40A3. Now, any person making payment to a goods transporter. So you have taken the service of a goods transporter and you're making a payment to goods transporter, any person while making payment to goods transporter, per day limit shall be 35,000 instead of 10,000. Per day limit shall be how much? 35,000 instead of 10,000. If you are a person making payments to goods transporter, then the per day limit shall be 35,000 instead of 10,000. Now, payment made by way of simple cross check or bearer check, both are not prescribed. That I have told you earlier itself. If you are making payment either by simple cross check or a bearer check, that shall be considered as not a prescribed method. Prescribed method means account pay cross check only. Now, prescribed mode means account pay check, account pay bank draft, ECS or prescribed electronic mode, just like debit card, credit card, GPay, Beam payment, RTGS, IMPS, NEFT, etc. Now, there are certain exceptions to 48.3. That means in the following circumstances, even if you are making cash payment exceeding 10,000 in a day, nothing shall be disallowed. In the following circumstances, if we are or if you are making cash payment exceeding 10,000 in a day, nothing shall be disallowed because you will be getting the protection of Rule 6DD, and that's what we are about to discuss right now. So, Rule 6DD, exceptions to 48.3. We will be understanding or will be discussing Rule 6DD, that is basically exceptions to 48.3. First one, payment to RBI, bank, LICs, etc., government, etc., nothing shall be disallowed. If you are making cash payment to RBI, Reserve Bank of India, banks, Life Insurance Corporation, government, nothing to worry. You can make any payment in cash. Nothing, no disallowances. If the payee is these persons, nothing shall be disallowed. Next one, payment by way of book adjustment. That means you have sold some goods and accepted some services. You sold goods of rupees 1 lakh and your buyer have done services worth 1 lakh. You sold goods to your buyer worth 1 lakh. Instead of giving money, your buyer have done some services of rupees 1 lakh. So you will cross off your liability. There is no payment at all and hence nothing shall be disallowed under 48.3. So it is just mutually crossing of liability. Shall be never disallowed under 48.3. Then payment for agricultural produce, fish products, poultry, dairy, meat, livestock, hides and skin, flowers, honey to the original producer. Say for example, you are buying fish for the purpose of export. You are buying fish from fishermen for the purpose of export. You are buying fish from the fisherman. You can make payment in any mode, no problem. You are buying poultry from the poultry farm, directly procuring from the poultry farm for the purpose of export or for the purpose of selling it outside or for the purpose of selling it in India, wherever you sell it. You are buying these products, forest produce, fish, poultry, dairy, meat, livestock, hides and skin, flowers and honey from the original producer. Then what is the advantage? Very simple, you can make the payment in any mode, absolutely no problem. You can claim the entire thing as a deduction. But if you are buying fish from a shop, buying fish or any of these products from a shop, then there will be disallowance if the single day payment exceeds 10,000. This have to purchased only from the original producer. Fish, fisherman. Agricultural producer, farmer. Dairy products from the farmer, dairy farmer. Meat from the butcher. That is what they are saying. Now, next one. You are making a payment to cottage industry, making products without the aid of power. Say for example, you are procuring a raw material from a cottage industry and the cottage industry is manufacturing the raw material without the aid of power. They are using hand machines or they are making it manually without any mechanized electricity driven machines, without using any electric driven machines. They are making everything handmade. You are buying this. No problem. You can make the payment in any mode. Next one. Payment made and pays place does not have banking service. You are making a payment and your pay is in a remote place where there is no bank available. You can make the payment in any mode. Absolutely no problem. Next one. Retirement benefit paid to employee. Limit shall be 50,000. Retirement or death related benefit while paying to an employee. In a day, you can make a payment up to 50,000. No problem. There is absolutely no problem. In up to 50,000, you can pay it in cash. Absolutely no problem. Okay. If the payment is more than 50,000, make sure that you are making the payment through prescribed mode only. Then salary to an employee. You are paying salary to an employee. And where is your employee? He is temporarily posted for more than 15 days in a place other than his normal place of duty. or he's posted in ship, and you have to deduct the TDS and pay the salary in cash. Nothing shall be disallowed. Imagine you are my employee working in, say, Bangalore. Okay, you are my employee working in Bengaluru. Okay, so I told you to work for another 3 months in Delhi. I send you to Delhi. We call it as sending you on deputation. I told you to work for another 3 months in Delhi. Okay, so you will go to Delhi, work there for 3 months, and I will come back. Yes or no? So this is a temporary posting because after 3 months service in Delhi, you can come back. So this 3 month salary I am paying in cash from my Delhi branch. This 3 month salary I am paying in cash from a Delhi branch after deducting the TDS. No problem. Say 1 lakh per month into 3 months. I'm making you the payment after deducting the TDS. No problem, because this is just like inconvenient. Because if I paid you salary through bank, maybe it will be difficult for you to withdraw the money and expend it in Delhi. It will be little bit inconvenient for you. For the sake of convenience, I am paying you salary in cash after deducting TDS. No problem. But this posting have to be a temporary posting which is more than 15 days. Or this posting have to happen in a ship, and I'm paying the salary in ship after deducting TDS in cash. No problem. So if you are paying salary to your employee who has been posted temporarily for more than 15 days in a place other than his normal place of duty or in a ship, and while paying salary I have deducted the TDS, then disallowance under 48.3 will never come into the picture. And finally, payment made by money exchanges for purchasing foreign currency or traveler's check. Say you are a money exchanger and you are buying say for example foreign currency or traveler's check. You are buying foreign currency or what? Traveler's check by paying money, by paying rupees. No worry, nothing to worry. Everything shall be deductible under 48.3, and there is no disallowance under 48.3 because money exchanges main business is to give money. Yes or no? Say for example, you are paying rupees 1 lakh. You are paying rupees 1 lakh for buying say $1,000. You bought $1,000 and you are paying, imagine it is 100 rupees. Okay, you are buying $1,000 from a foreigner and you are paying 1 lakh in cash. You are a money exchanger. So don't tell that you bought dollars by paying cash, that too in a single day, because that is your business. That is your business. It will not be disallowed under 40A3. That's what they are saying. Payment made by money exchanger for purchasing foreign currency or traveler's check. Not disallowed under 40A3. It is covered under Rule 6DD. And I hope that also was clear for you. Moving on to the next one. So that was a huge one, 40A3. Now moving on to the next one, friends, that is section 40A7. What is that? Gratuity provision fully disallowed. Very simple. If you are a person putting a provision for gratuity, okay, in your books of accounts, you have put a provision for gratuity. The entire provision amount that you put for gratuity is fully disallowed. Gratuity provisions are never allowed as deduction in the hands of any employers. You are paying gratuity, that is never allowed as a deduction in the hands of any employers. You will not get it as a deduction. But there is another thing. What is that? If you are making payment to a approved gratuity fund, or you are actually paying that gratuity amount to your retired employee, that is allowed as deduction. If you are simply creating a provision in your books of account, that provision created is never allowed as deduction. But actual payment of gratuity to your employees or payment of gratuity to approved gratuity funds, both are allowed as deduction. Are you with me? So gratuity provision fully allowed, fully disallowed, provision fully disallowed, actual payment of gratuity allowed, and payment to approved gratuity fund is also allowed. What is approved gratuity fund? You are maintaining a gratuity fund in an approved institution. Once your employees retire, that institution will pay the gratuity liability. So every month or every year you are paying something to that institution. That payment is allowed as a deduction. If you simply create a provision in your books of accounts, that is fully disallowed. Are you all with me, friends? Can you please respond? Yes, good, good, good. Very good, friends. Very good. So let's move on to the next point, friends. What is the next point? So please listen. Moving on to the next point. Last disallowance, section 43B. What is that? Following payments allowed as deduction on actual payment basis only. That I've told you earlier itself. Irrespective of your method of accounting. Irrespective of your method of accounting, the following expenses, if you want to claim it as a deduction, you need to make the payment on or before due date of filing your return. What is the due date of filing return, friends? There are three due dates, as I've told you earlier. It can be 31st October of AY if you are subjected to audit. It can be 30th November of AY if you are subjected to TP audit. If you are not covered under any of this, then it will be on 31st July of AY. These are the statutory due dates. Okay. Now, the following expenses are allowed as a deduction only on actual payment basis. That actual payment have to happen at least before due date of filing a return. So, actual payment should be made on or before due date of filing return. Otherwise, it's a temporary disallowance. What is temporary disallowance? Imagine my due date is on 31st July of assessment year. Okay, imagine my due date is on 31st July of assessment year. So, what the point is, say, in the year 2024-25, 24-25, my due date is on 31st July 2025. I made the payment on 15th December 2025. Then you tell me what will happen. In 24-25, it will be disallowed under 43B. In 24-25, it will be disallowed under 43B. In 25-26, I can claim it as a deduction. Why? Because in 15th December 2025, I have made the payment, which is after the due date of filing return. And hence, I can claim it as a deduction in 25-26, not in 24-25. So, that's what I told you. It's a temporary disallowance. Once you actually make the payment in future, in the year of payment, you can claim it as a deduction. Now, which all are the items covered under 43B? That is the question. Starting with the first one, any tax, duty, cess or fees, including GST, municipal taxes, etc. Whatever tax, duty, cess or fees, if you are about to claim it as a deduction, you have to actually make the payment. Otherwise, it is not allowed as deduction. Second one, employer's contribution to statutory provident fund, recognized provident fund, gratuity fund, etc. Hope you remember, employer's out-of-pocket contribution to statutory provident fund, recognized provident fund, gratuity fund, etc. is allowed as a deduction only on actual payment basis that have to happen on or before your due date of filing return. Otherwise, you will not be getting it as a deduction. Third one, any bonus or commission paid by the employer to the employee. If you are paying any bonus or commission to your employee, the employer, if you want to claim it as a deduction, it is not bonus shares, okay. You are giving employee bonus, share of your profit to your employee, according to the Payment of Bonus Act. So, if you are paying any bonus or commission to your employee, allowed as a deduction only on actual payment basis. Fourth one, earned leave encashment to the employee. What is earned leave encashment? Imagine an employee can take 30 days leave in a year. Okay, and the employee have been taken any leave at all. In a year, employee could have taken 30 days leave, but he haven't taken any leave at all. Then what to do? You tell me what to do. Very simple. In such a case, what you can do is you have to, being an employer, you have to pay 30 days salary to your employee because he haven't taken any leave at all. That means he have worked for an additional 30 days. So the employer have to pay salary to the employee. In such a case, that salary is normally called as earned leave. That earned leave is actually a cost for the employer, allowed as a deduction only on actual payment basis. So, earned leave encashment to the employee is allowed only on actual payment basis. Fifth one, payment to Indian Railway for use of railway assets. You are about to make any payment to Indian Railway for the use of any railway assets, you have to actually make the payment to claim it as a deduction. Finally, interest on loan, making payment to a scheduled bank, cooperative bank, NBFC, public financial institution, state financial corporation, state industrial investment corporation. You are paying interest and you have taken loan from either scheduled bank or a cooperative bank or NBFC non-banking finance corporate, or PFI, public financial institution, SFC, state financial corporation, SIIC, state industrial investment corporation. These interest, if you want to claim it as a deduction, you have to actually pay it. Otherwise, you will not be getting it as a deduction. This is what the department says. So these 6 items, if you want to claim as a deduction, you need to actually make the payment. This is what 43B is all about. That was the quick revision of 43B. So friends, listen. Till now, we have discussed a lot of deductions and lot of disallowances under this chapter PGBP. Yes or no? We started from section 30 to 37. Then we have discussed disallowances under section 40 and 40A as well as 43B. So this much is enough for any student to solve a numerical question. There are other sections also like 44AA, 44AB, 44AD, 44ADA, 44AE, etc. 44AA maintenance of books of accounts, 44AB tax audit, 44AD presumptive taxation, 44AD presumptive taxation for notified personals, 44AE presumptive taxation for goods transporters, etc. So for those things, you should study. That is altogether different thing. Okay, you can quickly cover all these things. But for solving a question up to 43B, these provisions are very much required. These are the frequently asked provisions in PGBP. So that is why I took these provisions only for the purpose of this revision. Are you with me? Not yet over. Now to the most important part of this revision. That is, if assessee, if you are an assessee, have opted for section 115 BAC, individual HUF, AOP, BOI, AJP can pay taxes as per the old slab rates. What is old slab rate? Up to 2.50 lakh nil, 2.50 lakh to 5 lakh 5%, 5 lakh to 10 lakh 20%, 10 lakh above 30% is the old slab. And there is one parallel option for individual HUF, AOP, BOI, AJP. If you are an individual HUF, AOP, BOI, AJP, you have a parallel option, and you tell me what is the parallel option. Under section 115 BAC, under section 115 BAC, you can pay taxes. That is a default tax rate. So if in the examination they are saying assessee is paying tax under 115 BAC. What is BAC? For you, for your September as well as January attempt, September 2025 and January 2026 CA inter students, up to 3 lakh nil, 3 lakh to 7 lakh 5%, 7 lakh to 10 lakh 10%, 10 lakh to 12 lakh 15%, 12 lakh to 15 lakh 20%, above 15 lakh 30%. This is the slab rate under BAC. If you are a student who is attempting September 2025 or January 2026, this is the amount. This is the slab rate. Now, if you are a person who opted for 115 BAC, what are the changes in deductions and disallowances? There are changes. There are a few changes. Let's understand. Changes in computation under PGBP if assessee has opted default tax rate under BAC. What are the changes? Number 1, you will not be getting additional depreciation. But you can claim normal depreciation, but you will not be getting additional depreciation if the assessee has opted for 115 BAC. Second one, no deduction for outside contribution made under section 35. Okay, section 35, scientific research expenditure. If you have paid any outside contribution under section 35, you will not be getting it as a deduction. If you have paid any outside contribution under section 35, you will not be getting it as a deduction. No restriction for in-house deduction. In-house deduction, that revenue and capital portion, that there is no restriction. But if you have given any outside contribution under 35, which all are the outside contributions? Number 1, to an institution or association which does scientific research, to an Indian company which does scientific research, to an institution, university or specified association which does statistical, social science or statistical research, and finally IIT or national laboratory for approved programs. All these 4 not allowed, opting for BAC. Then no deduction under 35 AD. Specified businesses, you cannot claim deduction under 35 AD, but Can that businesses can capitalize such amount and claim depreciation. Can claim normal depreciation, no problem, but no 35 AD. So these are the differences if assessee has opted for 115 BAC. Are you with me? So based on this, now based on this, what we can do? We can solve a question. We can solve a question which contains a lot of things, under PGBP, as well as it contains some basic adjustments of other heads as well. It contains some basic adjustments of other heads as well. So let us solve this question. Let us solve this question. So just go through this question. I'll be back in a moment. Just go through this question, friends. Just go through this question. Have a plain reading over this question. Yes, friends, I hope you have gone through that question. So we will solve this question together so that you will be getting an understanding over the entire things that we have discussed till now. Okay. So this question is basically your past exam question, which has been tested as a part of January 2025 CA inter examination. So I will make you solve this question. As you can see it from here. Yeah, this is the one. It is January 2025. It's a 15 mark question that has been tested in January 2025. So we will read that respective question together and we'll be solving the answer together. So I'll read the question from the beginning. So I'll teach you how to approach these kinds of questions in exams as well. Okay. So don't worry. We will solve it together. So I want all of you to take a note of this question. Open your notebook and take a note of this question in the way that I am writing. Okay, the presentation or the other things I'll show you how to do that. So I want all of you to open your notebook and write along with me. So this question, what they are saying is, I'll read the question from the beginning. Mr. Rohit, a resident individual, age 65 years. So 65 years is an important thing because if he's opting for the old slab rate, then his basic exemption limit will be up to 3 lakh. Since he is a resident as well as an individual, his basic exemption limit may go up to 3 lakh if he is opting for 150, opting for normal provisions. If he is opting BAC, then nothing to worry. He is a qualified medical practitioner. He runs into on clinic income and expenditure account of Mr. Rohit for the year ended 31st March 2025 is as under. So the previous year, the assessment year or the previous year, I will say, previous year will be 24-25 and AY will be 25-26. So we will write the assessment year. That is the best way to write the answer. So computation of total income and tax payable of Mr. Rohit for assessment year 25-26. For assessment year 25-26. This should be the heading. Now, under that, they have given net profit. So, you know there is PGBP head in this question. Okay. So, the one head that you are so sure about will be PGBP. So, I'm starting with the PGBP. Profits or gains from business or profession. PGBP. I'll start from the net profit as per P&L account. Tell me, friends, how much is the net profit as per the P&L account? It is 8,59,000, right? 8,59,000 is the net profit as per P&L account. So to make you understand this, I am writing it like this. Okay. So there will be other heads also. So if we jump into multiple pages, it will be very difficult to read the question. So consider these as 2 pages. This is page 1 and the other side is page 2. That you will understand because other head income comes in. I will write in this page itself so that it will be easy for you to copy your answer. Okay. Otherwise, it will be very difficult. If we jump from one page to another, it will be very difficult for you to copy it down. So I'll be making use of this page. Okay. Now, profits and gains on business or profession, net profit we have written. Now, don't read that expenditure and income side now. Jump to the following additional adjustments. You complete the additional adjustments, then you go back to the P&L account and check for the other items. This should be the approach. So, following is further information related to the financial year 24-25. So, all the informations are further informations. What is further information? If they say credited or debited to the P&L account, then yes, it is either credited or debited to the P&L account. Otherwise, the further items are not credited or debited to the P&L account. Are you with me? So, if they say the following one item is credited, then it is credited. Otherwise, these are additional informations only. So, what is the first information? He is a part-time, he is working part-time with Care Hospital Private Limited. His salary details are given there. Now, before reading that, what is the final requirement? You are required to compute his net taxable income and the net tax liability for assessment year 25-26. he has exercised the option of shifting out of default tax regime. So he is planning to pay tax under the old scheme. He has no plans to pay tax under the new scheme. He is planning to pay tax under the old scheme. So this is old slab rate. We consider it as normal provision. Normal provision. He is planning to pay tax under the normal provision, planning to pay tax under the old scheme. Alright, now, starting with the first item, basic salary is given, allowances are also given in the question. So, basic salary and allowance both have to be dealt under salary head, right? So, I will be writing basic salary. So, I will be writing salary head over here. Salary. So, basic salary. You tell me how much is the basic salary given in the question. Basic salary is 13,000 per month, right? 13,000 per month, and traveling allowance, transport allowance is there, 2,000 per month. So 13,000 into 12 months, that will be, how much is 13,000 into 12? So I'll do the math here. So 13,000 into 12, and that will be 1,56,000. And transport allowance. Now, transport allowance, listen, whether it is taxable or not, it will be fully taxable. Normally, transport allowance is basically fully taxable. If it is given to an employee who is either blind, deaf or dumb or orthopedically handicapped, you can claim an exemption. Otherwise, it is fully taxable. So, how much is that amount? 2,000 into 12 months. So, fully taxable, that is 24,000 only. So 2,000 into 12 months, that will be 24,000 only. And now, is there anything else they are saying? Further, during 24-25, his son had undergone a medical treatment in Care Hospital Private Limited, free of cost. The hospital would have charged a sum of 1 lakh for similar treatment to unrelated party. So his son have undergone a treatment in the same hospital where he is employed. So you being an employee or your relatives are undergoing a treatment, have undergone a treatment in a hospital owned by your employer. Then what is the speciality? Nothing shall be taxable as perquisite. If that hospital is a private hospital, whatever the bill repaid by the employer will be a taxable perquisite. This is a part of the salary. Okay. So if a person undergoing treatment in a hospital owned by their own employer, nothing shall be taxable perquisite. If you are undergoing a treatment in a government hospital, nothing shall be taxable perquisite. If you are undergoing a treatment for specified disease in a hospital notified by department, IT department, nothing shall be taxable perquisite. But if you are undergoing a treatment in a private hospital, then definitely it shall be a taxable perquisite. But this hospital is the Care Hospital Private Limited, which is your employer, and hence this 1 lakh is not a taxable perquisite. This note you have to write. So what you can do? Cost of treatment. Cost of treatment, you write nil. Even though you are not supposed to add anything to the numerical, you need to write a note. And what is the note? Exempted since medical treatment undergone in a hospital owned by employer. Owned by employer. This is not a taxable perquisite. This will be an exempted perquisite. And now you can take the total of the salary earned by the employee. 24,000 plus 156 will be 180 only. 180, 1,80,000 shall be the gross salary. Shall be the gross salary. And we will compute the standard deduction and the other things once we have dealt with everything. Okay. Because we don't know whether there are any other adjustment related to salary. So we will be dealing with the standard deductions and other things later. Okay. Now, coming back to the point. So this note exempted since medical treatment undergone in a hospital owned by the employer. That you have to write. Okay? Yes. To the second adjustment, what is that? First adjustment is over. Second one, he owns a residential house. Ground floor of the house, 50% of the portion is self-occupied by him, while the first floor of the house, 50% of the portion has been rented out since 1st October 2024. So, there is a residential house. To make you understand, I'll draw a chart. Say there is a residential house. 50% of the portion let out and 50% of the portion self-occupied. That's what they are saying. Yes or no? Now, is there anything else? It has been rented out since 1st October 2024. So this let out have happened from 1st October 2024. So we'll be getting rent from 1st October only. Then, what is next? What is the next point? The reconstruction of the entire house was started on 1st April 2024 and was completed on 30th September 2024. So there was some reconstruction that happened on 1st April and ended on 30th September 2024. The monthly rent is 10,000 per month. And tenant also pays 3,000 per month as a power backup charges. So monthly rent is 10,000. Rent is 10,000 and there is a thing called power backup charges. Some facilities are there. Power backup. Some generator facilities are there. Maybe something like that. Power backup charges 3,000. Both are received. Both are income. Okay, power backup charges. He took a loan of 12 lakh on 1st April 2024. So this guy have taken a loan of 12 lakh on 1st April 2024 is the date of loan. Okay, now what else? The interest on housing loan for a period of 1st April 2024 to 30th September 2024 was 60,000. So the interest on loan from 1st April 2024 till the date of construction is 60,000. Okay. So they have completed the construction that is given in the question. So we will take that. So the interest of loan, interest on loan from 1st April 2020 to 30th September 2024, okay, 24 is given. That is how much is the interest on loan, friends? It is 60,000. That's what they are saying. It is 60,000 and interest on loan for the period from the remaining period shall be 40,000. For the remaining period shall be 40,000. You don't need to split it as pre-construction and post-construction because both these two will be, because it is not pre-construction, not post-construction. The total interest is 1 lakh. And you can divide that interest into two. 50,000 for the let out portion and 50,000 for the self-occupied portion. Okay. Then what else is there? Friends, give me a second. Just a second. All right. So where were we? We were discussing that particular point. Yeah. So the interest for the remaining period is 40,000. During the year, he have paid municipal taxes of 40,000, 4,000, and for the financial year 2004-5 it is 6,000. So listen. Yes, okay. All right. So what are they saying is during the year he also paid municipal taxes of 2023-24. That is last year municipal taxes of 4,000 and 24-25. This year municipal taxes of 6,000. So municipal taxes, what is the treatment in house property? Municipal taxes is allowed as a deduction in the year of payment, irrespective of the year for which it is paid. That means last year municipal tax you paid this year, you will be getting a deduction this year. This year municipal tax you paid this year, you will be getting a deduction in this year. So both are allowable as deduction. 4,000 plus 6,000. That is the total municipal tax. So 4 plus 6, that will be 10,000 in total. But there is one thing, that is for the let out portion as well as self-occupied portion. So you have to divide that into two. So municipal taxes 5,000 municipal taxes for the let out portion and 5,000 municipal taxes for the self-occupied portion. That is the bifurcation. Now what to do? First we will deal with the house property. Income from house property we will deal. So income from house property. So under salary I am writing house property, okay. Under salary itself I am writing house property, income from house property. So we will deal with the let out portion first. Let out portion, that is 50% of the portion is the let out portion. So how much is the gross annual value? We don't have any standard rent, municipal value and the other things in the question. So we have to take the actual rent only for the purpose of this computation. And how much is the actual rent? Actual rent is how much? 10,000, that too from 1st October 2024. Yes or no? So 10,000 into 6 months, 60,000 will be the actual rent. So 10,000 into 6 months, 60,000 will be the actual rent. Actual rent will be 60,000. So I'll be displaying the screen in full, otherwise it will be very difficult for you to read, okay? Yeah. Alright, so 60,000 per month is the actual rent. Now, how about the municipal taxes? Can you claim municipal taxes as a deduction? Yes, for the let out portion, definitely we can claim that entire 5,000 municipal taxes as a deduction. There is absolutely no problem. So that 5,000 is definitely allowed as a deduction. Municipal taxes paid, 5,000 allowed as deduction. How much is the net annual value? 55,000. From that you can definitely claim standard deduction at 30%. How much is the standard deduction 30% on 55,000? 55,000 into 30% is the standard deduction, 16,500. 16,500 is the standard deduction. Then interest on loan. How much is the total interest of loan, friends? Total interest of loan is 50,000 for the which property? For the let out property. Okay, so 50,000 is the interest on loan, that also is allowed as deduction. And I think there will be loss. So if you claim these two, 55,000 is the NAV minus 16,500 minus 50,000, it will end up in loss of 11,500. So 11,500 is the loss from let out portion. Now, not yet over. Now, self-occupied portion is there. For that also you need to compute the income and the other things. So, yeah. So, we need to compute the income for the self-occupied portion as well. Right? So, self-occupied portion, again the balance 50%. As you all know, net annual value have to be taken as 0. You cannot claim municipal taxes for the self-occupied portion as a deduction. So, net annual value shall be 0. The only one deduction is for the interest on loan. The only one deduction that you can claim is for the interest on loan. That too, what is the purpose of loan? Purpose of loan is for the reconstruction of the property. Yes or no? Reconstruction of the entire house was started on 1st April 2024. Reconstruction. Self-occupied property. What is the maximum ceiling limit? The maximum ceiling limit shall be rupees 30,000. You cannot claim more than 30,000 as a deduction. So you can write a note, interest on loan. Purpose of loan is reconstruction. Hence, maximum limit shall be 30,000. You can claim only 30,000 as a deduction. So that will add to your loss. So again, loss from self-occupied. Loss from self-occupied property, 30,000. So how much is the total loss from house property? 11,500 and 30,000. It will be 41,500 is the total loss. Total loss, not less, it is loss, okay? Loss from house property is 41,500. Now you will ask me, sir, wait, there is something that you have missed. What is that? Power backup charges, that is also your income. You haven't considered it under house property. You tell me whether we have to consider it under house property. The answer is no. Power backup charges is an extra facility charges that is not related to rent. Okay, so that power backup charges have to be assessed under IFOS, it is not related to your house. So that have to be considered as your income under IFOS. So I am opening the next head under this IFOS. Power backup charges. And how much was the power backup charges? It was 3,000 per month, right? That too, he occupied for not 12 months, 6 months only. And hence it will be 18,000, right? It will be 18,000. So that have to be dealt under the house, IFOS, not under house property. Now, moving on to the next point. What is the next point, friends? So there are any other points, let's see. All right, so these are the things that they are saying. So let's read that point again. He owns a residential house. Ground floor of the house is self-occupied and the first floor is let out from 1st October 2024. The reconstruction of the entire house was started and completed on 30th September 2024. Housing loan of 12 lakh as on 1st April 2024. Interest on housing loan we have done 60,000 for the period of 4,000 and 40,000. Okay, no other adjustment is there. And there is what is power. Tenant also pays 3,000 as a power backup charges. Okay, absolutely no problem. There for the time being, there is absolutely nothing more is there. So reading with the next adjustment. Other information. Payment of salary of 25,000 per month to sister-in-law of Mr. Rohit, who was in charge of accounts and receivables department. However, in comparison to similar work profile, the reasonable salary at market rate is 20,000 per month. So, next question, Rohit have paid how much? Rupees 25,000 per month to whom? To sister-in-law. Sister-in-law means his, not sister, it is in-law. Okay. Now, what they are saying, the normal market salary is 20,000 per month. So don't jump into conclusion by saying that it is an excess payment to relatives, because sister-in-law is not a relative under 48. Hope you remember, we have learned it today. For an individual, who all are the relatives? For an individual, relatives means their spouse, then ascendants, descendants, their brothers and sisters, not in-laws. So whatever payment that you are making to your in-law is not a excessive payment to relative. So what you need to write is, under PJBP, you write payment of salary to sister-in-law. Do nothing, because sister-in-law is not a relative under section 40A2, and hence you don't have to do anything with that. But you need to write this note, because this note does carry marks, friends. If you don't write this note, then you will lose that corresponding mark, that is for sure. Moving on to the next one, B. Convenience expenses. Convenience expenses include a sum of 12,000 incurred for convenience from house to Care Hospital Private Limited and vice versa in relation to his employment. So he have paid some convenience expense. That means he might have incurred some he incurred some traveling expenses. Convenience means the travel. Okay, convenience expenses that he have incurred. That is around 12,000 rupees. That's what they are saying. So convenience expenses, out of that convenience expenses 24,000, 12,000 have been incurred for the purpose of traveling from house to hospital. So you tell me what to do with that convenience expense. That is a personal expense. That is a personal expense, not the entire 24. Out of this 24, 12,000 incurred for convenience from house to hospital and vice versa. In relation to his employment, that has nothing to do with PGBP, not related to your business or profession. Since that entire convenience expense have been debited to the P&L account, out of that 24,000, you need to add back 12,000. So what I'm doing, I'm adding back 12,000 as next item. Okay, so convenience expenses from house to office, house to hospital, considered as a personal expense, not related to business. So that 12,000 you need to add back. That since it is debited to the P&L account, you need to add back because it is not an allowable expenditure. Okay, I hope you are getting my point. Moving on to the next one, friends. Next point, what is that? Power and fuel expenses include a sum of 6,000 incurred for generator fuel for providing power backup to the tenant. Okay, it is related to our power and fuel. So you tell me what to do with that 6,000. That is allowed as a deduction from IFOS. No problem. That's 6,000. But power and fuel expense here, power and fuel expense out of this 24, 6,000 related to power backup or diesel expenses that you have incurred for providing power backup to the tenant, that have to be added back to the PGBP and you have to deduct it under IFOS because that power backup charges is an income taxable under IFOS. So this expense have to be considered under IFOS only. So what you need to do is next item, power backup expenses under IFOS, not connected to business. How much is the amount, friends? It is 6,000. You need to add 6,000. And this have to be dealt under this expenses for power backup. $6,000 have to be deducted from here and the remaining amount will be 12,000. Let it be there under IFOS. Okay. Moving on. Moving on to the next point. What is the next point, friends? Next point is, administrative expenses include sum of 10,000 paid as municipal taxes for this house. So in the administrative expense 10,000 is for the municipal taxes that we have already dealt under house property. So you need to add this 10,000 from the P&L account because that has been wrongly debited in the P&L account. Yes or no? That is related to your house property. So you need to add that 10,000 to your net profit to arrive at the correct figure. So next adjustment is municipal taxes paid related to house property not connected to business of assessee. So you are right, municipal taxes paid relating to the residential house included in administrative expense, not deductible. Since it is debited to the P&L account, you need to add back. How much is the amount? 10,000. That entire 6 plus 4, 10,000. You need to add back. Okay. Now, clinic equipments are opening WDV as given, fresh purchase made on 28th August 2024, 25,000 was paid in cash. So there it is given for computing depreciation. So you need to check whether they have claimed depreciation in the P&L account. Staff salary, administrative expense, convenience, power, interest, housing loan, amount paid to scientific research, net profit. So they haven't claimed depreciation. So you need to provide for the depreciation. So let's compute the depreciation right now. So we can write less depreciation under section 32 for clinic equipments. Clinic equipments are considered as plant and machinery depreciable at 15% rate. Okay, normal plant and machinery depreciable at 15% rate. And can you tell me how much is the opening WDV value? They have given it in the question. Okay, how much is the opening WDV value, friends? The opening WDV value is 1 lakh. So 1 lakh is there. Then they are saying some additions. How much is the addition that they are mentioning? Fresh purchase during the year. How much? It is 25,000, but it is paid in cash. Hope you remember the explanation. If you have paid any amount in related to a asset exceeding 10,000 in a day, then the method of payment have to be either account pay check or account pay bank draft or ECS. Since in this question the payment have been made in cash, you cannot claim that 25,000 as a part of the actual cost. So you have to write the note. What is that note? In under addition, you write nil and you need to write the reason why. Since payment exceeds 10,000 paid by cash, assessee cannot claim depreciation or cannot treat it as a part of actual cost and no depreciation on that. About the point is you can only claim the actual cost that are allowable is only 1 lakh, okay, and into 15%, that is the maximum depreciation that you can claim over here. So that will be 15,000 rupees. That is the point. That is the allowable depreciation that you can claim under this point. I hope that also was clear, right? So this is the way that you have to write. Okay, in examination you have to write everything in 2 different pages. Okay, like the house property, salary, everything, and in different page. Here to bring it in 1 page, otherwise it will be very difficult to read. When we compute the total income and all, we have to jump from 1 page to another. So only for the convenience I have divided this page into 2. In examination you have to write the salary, house property, everything in different pages. Now moving on to the next one, friends. What is the next point? He paid tuition fees of 40,000 for his granddaughter, which is debited to the capital account. Okay, they are not saying P&L account. They are saying capital account. So it is not deducted. Okay, not deducted anywhere. So, but you need to write a note for that. You need to write a note for that. What should be the note? That is basically, you don't have to you don't have to write anything under PGBP. Tuition fees. What to do with the tuition fees? Normally, if you are paying tuition fees for your children under section 80C, you can claim. Tuition fees are normally allowed as deduction under 80C. But since in this case it is paid for whom? It is paid for granddaughter. You cannot claim it as a deduction under 80C. So what you can write is, under PGBP, you can write tuition fees. Tuition fees, you can write nil. Not adjusted in P&L. It is directly adjusted under capital account, just like a drawings that they have treated. Okay, tuition fees, no treatment. It is not dealt under P&L account. It is considered as a drawings that will not affect our net profit. Are you all with me? Have you understood what I said? If it is debited in the P&L account, then you should have to add it back. Since it is not debited in the P&L account, they are clearly said that it is done as a withdrawal, as a drawings from the capital account. There is no effect on your net profit. Okay, so you have to be careful with that. So what you can write as nil, and under that you can write chapter 6a. Chapter 6a under section 80C you can write tuition fees and nil. Why nil? Paid for granddaughter. Not allowed as deduction. Not allowed as deduction. This you need to write. Moving on to the next point, friends. What is the next point? He availed a loan of 8 lakh from bank for higher education of his son. He repaid the principal of 50,000 and interest of 26,000 during 24-25. So go to the P&L account. Interest on education loan for son. And interest on housing loan is also there. Okay, that we will deal later. Interest on education loan for the son. It's a personal expense, not allowable as a business deduction. So first of all, you need to add back it from the net profit. And interest on loan, you can claim as a deduction under 80E. If you have taken a higher education loan, whatever interest that you are paid for that higher education, either for your higher education or for your dependents higher education, family members higher education, or son, daughter, etc. higher education, you can claim it as a deduction under 80E. So what you can write is, two things are there. He repaid principal of 50,000, not allowed as deduction. Interest allowed as deduction under 80E. So 2-3 things you have to do. First of all, under PGBP. Under PGBP as a next item, interest on loan for what? For higher education. Personal expense not allowable as deduction. Personal expense. And hence, how much is the amount, friends? The amount is amount debited in the P&L account, 26,000. Then, under chapter 6a, under section 80E, interest on higher education loan, 26,000 allowed as deduction. Principal repayment not allowed as deduction. For this also you have to write a note. Principal repayment in relation to housing loan, not housing loan, sorry, higher education loan, not allowed as deduction. Only the interest portion is allowed as deduction. This you need to clearly write. Then what's next? Moving on to the next point. I think this is it. There is nothing more. You are required to compute this net taxable income and net tax liability. Okay, you need to compute the net tax liability. Now, before computing or concluding everything, just go through the P&L account. Salary to staff, no problem. Allowable as deduction. Administrative expense already dealt. Convenience expense already dealt. Power and fuel already dealt. Interest on housing loan, 1 lakh. Personal expenses, debited in the P&L account. Add back and claim it as a deduction under house property. Yes or no? So, interest on housing loan, you have to deal. So, what you need to do is add back as a next item under interest on housing loan, 1 lakh. Add back. And under house property, you have already adjusted it. Okay, house property, we have already adjusted. We have already computed the income from house property. Then, amount paid to Scientific Research Association approved and notified under 35. Debited to the P&L account, allowed as a deduction, no adjustment required. Okay. Then, consultation fees, 22,000. Nothing, it is your PGBP income. Salary received, 1,80,000. Salary received, 1,80,000 is there, credited in the P&L account. That have to be deducted. Okay. So, salary received. $180 that have to be dealt under salary. So you have to deduct it. Since it is credited to the statement of P&L account, we have to deduct it. Rental income from house property that have to be dealt under house property. So you need to again deduct it. Rent related to house property. How much is the rent related house property, friends? They have credited 78. So you have to deduct 78. Okay. Because that is, they might have added that both the power backup charges as well. So that is why it is 78,000. So you need to deduct 78 and we have already computed house property income. So do nothing in the house property head, that we have already done. And the final item is dividend from foreign company dealt under IFOS. So again, less it from PGBP. Foreign company, how much is the dividend? 10,000. And add it under house IFOS dividend. Foreign company, 10,000. Acha. So that's it. There is nothing more pending. My God, big question, right? So we need to add and compute everything together. Now it's a tough task. 8,59,000 plus 12,000 plus 6,000 plus 10,000 minus 15,000 plus 26,000 plus 1 lakh minus 1,80,000 minus 78,000 minus 10,000. And can you tell me how much is the PGBP income coming? Please help me in computing the PGBP income. It is 7,30,000 coming, right? Can you just check it whether it is 7,30,000 coming? Check it and tell me the figure. That is the profits from business. Is it 7,30,000, my dear friends? Please respond. Is it 730? PGBP, not gross total income, it is PGBP. Now you have loss from house property, 41,500, and you have IFOS. How much is the income from IFOS? 22 plus 10. Sorry, 12 plus 10. That is 22. That is income from other source. Okay. Then there is something pending in salary. That is standard deduction, right? How much is standard deduction? 50,000, old slab rate. New slab rate 75,000, but since you have opted for old slab rate, it is 50,000 only. So 1,30,000 salary. Now we can adjust that net of that house property losses. Okay, you can net off that house property loss with any income, whether it is salary income or whether it is PGBP income, doesn't matter. You can adjust that loss with any income. There is absolutely no problem. Okay. So how much is the gross total income? Gross total income. We will take 7,30,000 plus 22,000 house property. 22,000 house property. Then you have a loss from, sorry, not 22,000, not from house property, it's from IFOS. Then you have a loss from house property 41,500 minus 41,500. Then you have a salary income of 1,30,000, right? Plus 1,30,000. So that will give you 8,40,500. Gross total income is 8,40,500. Chapter 6A reductions are there. 26,000 is the only one chapter 6A reduction that we have. So we deduct 26,000 and it will be 8,14,500 is the total income. On that you compute the tax liability. We will take basic tax first. Since he is a senior citizen, up to 3 lakh nil. because assessee is a senior citizen having an age of 60 years plus resident up to 3 lakh nil. Then 3 lakh to 5 lakh, 5 percentage, that will be 10,000. Then 5 lakh to 8 lakh 14,500 into 20 percentage, that will be around 814,500 minus 5 lakh is subjected to 20 percentage. That will give you 62,900. Adding these two, 72,900 is the basic tax. Cess 4%. So that into 4% cess, that will be 2,516. Add that also, that will be 72,900 plus 2,516, that will be 75,416. Applying round off, 75,420 is the final tax liability. It should be the final tax liability. Okay, I think I have missed something. There is some calculation error. Let me check. 62,900, it is 72,900. Okay, 72,900 into 4% will be 2,916. Okay, there is small calculation error. It should be 2,916. Okay, and there is a small change in the answer. Cess calculation, 4% on 72,900 is 2,916. Okay, so 2,916 plus 72,900 will give you 75,816. So 75,820 should be the answer. This is how you have to compute the final answer. So have all of you got the final answer? Is everybody with me? Are we on the same page? Can you please respond? Are we on the same page, friends? Have you all received the final answer? Yeah, so this is the way that you have to compute the answer, friends. In these kinds of questions, if they are asking in exam, this is the way that you have to write the answer, okay? Okay, so by that I can say our PGBP revision is over because I have taken a past exam question and we have solved a past exam question. These kinds of questions will be definitely there in exams. Now, if you have any doubts, you can post your doubts in live. I'll address your rest of the doubts. Otherwise, we can call off the session because this was the intent to cover PGBP. I hope this session was useful to you. So, if you like this session, please don't forget to share this video to your friends and colleagues. Then, if you have any specifics or doubts or something like that, you can post it in chat. I'll address it. I'll wait for 2 more minutes. If you have any doubts, you can post it in the chat. Alright friends, so since you are not posting anything, I think everything is clear for you. So all the very best for your exams. Prepare well. Is there order for writing the heads in exam? No. You don't have to write first salary, then house property, then PGBP, then IFOS. That order is not required. No. Nothing. Treat everything separately. Okay. No problem, Shamsul. There is nothing called an order. It's not mandatory. You can start with the PGBP, then you can write house property, then salary, then IFOS, no problem. Yeah, you can write like that, no problem. You can write PGBP first, then house property, then salary, then IFOS. Yes, yes, no problem at all. All right, friends. So that's it. Thank you for attending the session. Hope it was useful. It was a quick revision of PGBP and we have solved a past exam question as well. So that's all. Take care. All the very best for your exams. Prepare well for your exams. Have a blast. Score well. Go through your other chapters as well. So take care. See you and all the very best for you.